So again,
Hmm.
it's not going to be what these companies report. It's going to be about what they say about the rest of this year. And if their guidance, so two things are potentially, and so here's two of the potential risks. We talked about those earnings being very optimistic for this year. If we go through this quarter's earnings season and outlooks are starting to get cut back, we're going to see those earnings estimates drop. And that's going to make valuations more difficult to justify at current levels. So that may induce some more risk into the markets worth paying attention to. If
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart. I'm very excited to welcome you all here at the end of the week for another weekly market recap featuring my good friend, the Argentine portfolio manager, Lance Roberts. Lance, how you doing?
I am not in Argentina, I'm in Houston.
Yeah.
So
Well, folks may know Argentine is a derivative of argentum, Latin word for silver. And right before we hopped on here, Lance,
uh-huh.
silver finally cracked $100 an ounce. So we got a
Yes.
lot of celebration going on. We'll talk a little bit about that, both to celebrate the win, but also to urge a little bit of caution here. But anyways, for everybody who has followed the silver ride, especially those of you who got in, 6 months ago, went back when it was 35, or 6 years ago when it was much lower than that. Congratulations to you all. Um, but yeah, it's a great day for anybody who's got any interest in silver.
Yeah.
And Lance, it raises the question. So what do you think is going to be hit next? 5,000 gold or 7,000 S&P? Because we're very close to both.
Yeah, no, look, all asset classes are running right now, and it's great. I mean, pretty much, as we talked about before, you can pretty much throw money into anything and it makes you money. And I love markets like that. It makes it really, really easy to make money. And since that's what we're in the business of doing, right? That's why we all invest is to make money. This has been a great, such an easy market over the last few years to generate really outsized returns. I don't know how long it lasts. That's kind of the theme of today's article, which is called the South Park market.
Yeah, we're going to
But
get to that.
yeah, yeah, but it's man, enjoy it. It's so easy, just I encourage you though, just to be a little bit mindful about managing risk and just take some profits along the way. These prices aren't going to last forever. These things eventually always reverse, and doesn't matter what asset class it is, you're going to have a reversion in price at some point. So just don't forget to take some profits along the way and manage your risk. But yeah, it's great.
All right, so we're going to get into all of that. First, let me just congratulate you and the entire team at REA. You guys put on a wonderful conference last weekend, and I was out there for it. Had a great
Yeah,
time. And from what the audience told me, they did as well. A few things I want to talk with you about that, but you, Michael, and I did kind of a live weekly
yeah,
market recap there on the stage to conclude it. And I was kind of digging around with you around the nature of this market and sort of finally got to the type of answer I was looking for from you, which was sort of given the arc of your long career in this space, how are you looking at today's market? And I can't remember the exact words that you used, Lance, but you basically did say like, look, this is one of the most overvalued markets, if not the most overvalued market I've seen in my professional career. That was not a message to say everybody sell right now and get in the bunker, but I found that was very important to hear because yes, you're playing the market you have, you're dancing while the music's still playing, but you do have a caution in your head saying, look, I've been around for a long time and I've never seen things this deviated from their means.
yeah. No, and again, when you look at that, and again, this is also if I have some charts and stuff that we can go into when we get into the article here in a minute. But um, look, when you see this type of market where stocks generally always kind of go up first, then it begins to drag every other asset class up with it. And that's because as money's made on one side of the ledger, then people start looking like, okay, here's the next opportunity. So I go buy this asset, and then kind of speculators move into that market, and that pulls those prices up, and then we find the next market, so forth and so on. And eventually that always, whether it was 1999, 2008, 1987, whatever, those always culminate in eventually a risk off event for whatever reason. And look, there's always a catalyst that causes that reversion in price, and we just don't know what that catalyst is going to be, whether it's going to be something credit related, economic related, whatever it is. And that doesn't mean today by any stretch of the imagination. Just because markets are overvalued does not mean that markets are going to crash. I'm actually writing an article about this in the next couple of weeks called the boy who cried wolf. And there's that old parable, Adam, about the young boys out in the sheep, tending the sheep, and he gets bored, so he runs in town screaming wolf, and there's no wolf. And so the everybody runs out there to defend the flock, and he does this a couple of times because he's bored. And then a wolf eventually shows up and nobody listens. And the reason that parable is important is that's the message from valuations. And one of the things that you and I have both seen over the last really kind of 3 years is that we've seen a lot of people come on to different media channels, exceptions like, oh, the markets are going to crash. Valuations are very high, and that always means markets are going to crash. And while there's truth to that statement, it doesn't happen immediately. And so when valuations are high and these messages come out and then nothing happens, we begin to ignore the risk. It's like, oh, this time's different. These asset prices are just going to go up forever because
Mhm.
there's a supply demand imbalance, or there's this reason, or there's that reason. But we ignore the risk because the risk haven't presented themselves. It's these markets just ignore all the risks, so everything's fine. It's different. But that's the trap that investors get themselves into. And so, yeah, eventually these valuations are going to matter. The price deviations in metals are going to matter. That supply demand imbalance is going to shift at some point. And there's going to be big reversions in all these asset classes back towards their means. And that's just what history tells you. Just take a look at any price chart of any asset class going back. They go up and they also go down. So what's important is just don't forget about that risk management in your portfolio. Be sure, remember, take profits, rebalance risk, reallocate capital to, other places. We just did that recently in our all-weather model. We just sold some silver just yesterday, as a matter of fact, and bought Bitcoin because Bitcoin is completely beaten up right now. It's very
Mhm.
oversold, starting to show some signs of life here a bit. So there's a good potential rotational setup where I can take an overvalued asset and go buy an undervalued asset and maintain that volatility ratio within my portfolio.
All right. So, very good point. Um, we're going to talk in more specific about your article in just a second, but just a couple things to react to there. One is I was literally just talking about this yesterday. My daughters are now getting older. I've got a daughter who's entering her mid 20s. I've got one who's 19, so she'll be 20 next. Um, they're nowhere near looking like they're going to get married anytime soon. But I'm already starting to think about grandkids. What it's going to be like, and was trying to think about what books would I want to give them, right? What would I want to what library would I want to build for them when they're young? And I was reflecting on one of the books I read a lot when I was a little kid, like 5 years old type of thing, and it was Aesop's Fables.
Yep.
And those are timeless stories, right? I mean, the stories are literally thousands of years old, right? I mean, I think a lot of them date from ancient Greece, and they're true. I mean, or they're truisms, and things like The Boy Who Cried Wolf, right? I mean, you learn the dangers of doing that, when you're young reading this. Same with The Ant and the Grasshopper, like a lot of kind of almost sort of like the financial values I think I developed, where the seeds were planted there with Aesop's Fables. So anyways, your story there about The Boy Who Cried Wolf resonated with me. But yeah, I feel badly. Like, I don't think I got that book for my girls when they were young. So hope to remedy that with the next generation. Um,
It's not too late. You
but
can buy it from now and have a night just reading fables.
yeah, well, maybe I'll do that. Like, why am I reading this
Sit them
children's book?
down over dinner and say, "Look, I forgot to do this when you were younger, so we're going to do it now." So
Yeah. Here, climb in my lap, and I'm going to read it to you. Yeah, make it as awkward as possible.
exactly.
Um, but to your point there on silver too, I just want to do a few things. And by the way, folks, you you'll be harder pressed to find somebody who has believed more in silver and still does. I actually think that silver price will go higher in the future. Just to Lance's point, the big question there is when and at what speed. And I think that the metal has just moved so far, so fast here that to expect it to continue its current trajectory, I don't think it's particularly realistic. And I think it's actually kind of gluttonous, right? I mean, you've been given a massive gift of, price appreciation that I think nobody expected 6 months ago. And just to expect that to continue, it's really not that realistic. And let me just show you what I'm talking about here. So here is the price trajectory of silver, right? Lance, these exponential slash vertical moves in any asset class, you strip the name silver off there. If I showed you this chart about any asset class, I think you would say, hey, look,
Yeah.
take some gains in that thing, buddy. This is not going to last forever, right?
No, no, that's right. Let me, if you don't mind, let me swap share you charts real quick because this is
Great.
one I was just looking at this morning.
All right. I'm going
Um,
to swap share back after you do that.
Yeah, that's completely fine. So here's a long-term chart of silver. This goes back to the late 1970s, and there's a couple of things to take away from this. First of all, just remember that silver is used in the production and manufacturing process, right? So, right now the big narrative behind silver is this supply-demand imbalance is that there's not enough supply of silver to meet the underlying demand. That's a true statement. Nothing wrong with that statement at all. Now, the question, though, is twofold. One, is the current price appreciation greater than the supply demand imbalance? In other words, is it overpriced relative to the supply demand imbalance? Or what happens when the supply increases? So, a couple of things that can increase supply, of course, is that when you have high prices, that certainly encourages miners to go out and extract more silver or more metals from their various assets, and maybe doing it in a more unprofitable way. So they're going to go drill more mines that were previously unprofitable or hard to get to are now worthwhile doing. So that will help increase supply. The other side of this is that we talk about inflation all the time. If you're buying an electric vehicle, and these are the big stories right now. Oh, it's the rise in the data centers, the EVs, the solar panels. Those all use a lot of silver. True statement. But that means that incremental cost into those products is rising sharply. And what happens is you get a fall off in the demand equation. Then all of a sudden, supply is able to catch up. So when supply and demand rebalance themselves, the price is going to become under scrutiny. And this is what's happened in the past. We've had supply demand imbalances before, and then the price runs up, and it can stay elevated for quite some time, as you can see in the chart. But when you're 6 standard deviations above, this is a monthly chart, by the way. So this is you're looking at the 200-month moving average, which is currently around $30 a share right now for
Wow.
silver. You know, and if you'll notice, the price has always reverted back to that 200-month moving average, in previous spikes. It always comes back to that level because that's where the economic balance is for silver historically. So when you start talking about a reversion to the mean, you're talking about a reversion from 100 back to 30. So now again, I'm not saying that's going to happen, but and when you're 6 standard deviations above your long-term means, that becomes more problematic in terms of what happens gravitationally. Because remember, the most important thing is this market, what you're looking at right now, this is not a function of physical demand at all. There is no physical demand input into those prices. This is all futures being traded on the New York on the New York Mercantile Exchange. It's just that this is large commercial speculators betting on the price move right now. And so when something ultimately reverses and they run those contracts in the other direction, that's why your reversals can be so sharp.
Yeah. And now, look, to your point about narratives, there's going to be a bunch of people watching, pushing back on this and saying, Lance, but you don't get this part, and it's different this time for this reason. The
Again,
honest answer is,
it's always different this time.
it is, and look, it could be. The honest answer is we just don't know. But you're
Yeah,
walking through the math, the statistical math here that you have to be you're fighting right now. If you're saying, look, it's not going to correct.
that's right.
Look, I'm still bullish. I actually think there are elements that wouldn't surprise me if it is different this time. But it's all about price and value, right? Which is okay. Well, what is given all that? What is the true price right now? I don't know. I mean, I think it's higher than it was, back at 35 back in June, but it's moved so far so fast. I am totally open to just the dynamics of price action to say, hey, look, things tend to get overheated way ahead of themselves. A chart like you just showed, that is an extreme of an extreme. And so I think to just be naked long here is, it's not responsible. Now, could silver still go a lot higher here? Absolutely. Like I said, I'm a big fan. I haven't sold any of my physical ounces. I'm not going to. I'm still in it for the long haul. But two things I just want to note. One is, folks may remember, I put on the silver laser eyes on my profile photo on X. And back when silver made its breakout above 35 back in June. So again, big fan of silver here. I think I was one of the first, if the only people to actually do this. And as a result, if you have followed me on this trade, congratulations. I'm only going to ask for 20% of your gains above $35 an ounce. You can send those to adam@thoughtfulmoney.com. But I am hanging up the silver laser eyes for exactly the reasons we're talking about here, Lance. They have totally done their job. I think to ask for more out of them, like I said, is not just unrealistic, but I think just downright gluttonous at this time. And I remember the Wall Street axiom that pigs get fat, but hogs get slaughtered. But I do want to take them out just for one last ride. So if you'll bear with me here, Lance, let me do that now.
Nice. Very nice. But you bring up an interesting point though, Adam, which is, so let me ask you a question. So you have a lot of physical silver. I get that, and that's great. But why would you not sell some of your physical silver here? And because we know historically prices going back to 1970 that this may be the highest price. You may get slightly higher prices in silver. Maybe you go to 120, maybe you go to 150,
Yeah.
maybe this is the case. But these are probably prices that you're not going to see again for 30 years. And so, and even if you expect silver prices to go higher, right? So there's an economic balance for metals, right? Their use in jewelry to the use in manufacturing. So there's a supply demand equation that'll work out there. So why wouldn't you sell some, not all, but sell some physical silver and look to buy it back at cheaper levels? Maybe that level's 50, maybe it's 40, maybe it's 30, maybe it's 60. But why wouldn't you sell some physical here and buy back physical later cheaper and
It's
capture that gain rather than just
it,
write it back down again?
it's a totally fair question. For me, there is a part of it. I know you're not going to like this word. I'm going to say in the debasement trade, and I don't mean in the sense of how it's just been used in the past couple months, but as you and I have talked over the years, everything we talk about is probabilities, Lance.
Mhm.
The thing that I have one of the highest probabilities, highest levels of confidence in is that the purchasing power of fiat currency is going to lose value over time, right?
Inflation, yes, of
Yeah. So
course.
I want to hold part of my assets in actually real, tangible, physical things whose intrinsic value can't be inflated away. Now, I know you're going to say, "Hey, look, let me show you the charts. Stocks have done better
But
than I'm
but
going
but
to."
you haven't solved that issue. You're still invested in dollars, even in silver. Because
Yeah, but
to spend, so if let's just say currency goes away, you've now got to spend, or let's say the world ends, as so to speak. But to spend that silver, you've got to convert it back into dollars. You can't go down to Starbucks and shave off a little smidge of silver and buy a cup of coffee.
well, if the world ends, yeah, you can. And I've got my junk silver where I can take out my little,
Mm.
Mercury dime and pay for something with that. But that's not really why I own it. I
Right.
don't spend a lot of
But no,
time.
my point is more fundamental. You're not going to get any younger, neither am I.
Yep.
And let's say the price reverts back to 30 for the next,
Right.
15,
30
20.
years. Do I have 30 years to wait on that?
Oh, yeah.
I don't.
And again, you sell some here, and again, you buy it cheaper. You're still not getting out of that trade. You're just managing, you're just taking some extremely insane profitability out of this, capturing that value. Your wealth has now increased. And then at some point down the road, I'm not saying sell it all either. I'm not saying haul all your silver down and sell it. We're still long silver and gold and uranium in our portfolios, but we're taking profits
Right,
because
you're taking profits. Yeah. And just to be clear,
this is not
I'm
gonna,
taking
this is gonna last.
I'm taking profits in paper physical
Sure,
exposure. So
sure.
it's not that I am taking some off the table and I am using hedges and I put a hedge on this
Yeah.
morning. against my physical silver part. So I'm not just going blindly long. And like I said, this isn't all of my wealth, right? And so
Oh
I
yeah,
want
yeah.
to hold some of my wealth in atoms, right? Not in paper claims, not in digital bits, right? Which and I do in other things. So
Right.
part of the answer there is just I'm holding it because I still believe in the long-term value. And to your point, Lance, let's say it's another 30-year cycle, and let's say I'm dead by then, right? Well, this is part of what goes on to my progeny, right?
Right.
Yeah,
And I guess the
it's not
question is,
all of
man,
my
what's the
wealth. I'm not completely tied to the mast on this
yeah,
one.
yeah. No, so that brings up an interesting point. So why would instead of holding a silver bar as an example, which is totally tied to the commodity, price driven by the futures market, why would you
Yeah.
not own numismatic valued coins instead? So in other words, buy coins that have a collectible value that's not tied necessarily to the commodity price because they hold an intrinsic value because of their rarity. Would that be a better way to store your wealth?
Yeah, I think that's not a bad question. Um, uh, One, you have to become an expert in this. So this is something that takes a fair amount of time, right? Because the numismatic world, like any sort of collectible world, there's a lot of scams out there. There's a lot of things that you can be oversold.
Yeah.
Part of that is I'm just, I've got lots of other things I'm spending time on. I don't necessarily want to become a numismatic expert. And I do feel
Well,
that
hopefully you have a trusted advisor for that. Like, I mean, somebody that is an
yeah,
expert.
you could get a coin guide, and like I said, that I would if somebody has that interest, absolutely, right? You've got an additional optionality value on your gold. You've got the underlying gold content, and you've got the collectability value. Um, yeah, no, I think it's fine. I do think for some of the people who are more worried about kind of end of the world type stuff, and that's why I'm holding gold, and I'm not really one of those guys. But I have thought like, well, in that case, the numismatic value kind of just goes away because nobody really cares about collectability. They've got a
You
bigger
better
pro.
have lead. You better have more lead than you've got silver at that point.
Yeah. And it was interesting. My father, for a time in his life, collected US currency. And
Mhm.
this is like old notes, like Continentals and early
Yeah.
forms of the dime. He really got into it. But I do remember, like, it took a lot of his time.
Well, yeah,
Um,
that's a hobby, right?
yeah, but I mean, like, he really had to get very well educated because there was a lot of kind of crap out there, shysters and people selling you, well, here's, this is why this thing is so valuable. And then you do the research. And my dad was probably somewhere on the spectrum, looking back in retrospect. And he would just do the work to finally be like, you know what, I actually think that's a bad deal. I've got way more other things that I'm trying to, I'm just right now still holding on my fingernails trying to get done in my life. So, but it's not a bad question. Yeah. And look, I think it's super fascinating. And I think I told a story. I think I told a story here about going to see one of the world's best mineral collections recently. And I mean, it's wicked cool when you see what an expert collector can build.
Yeah, yeah, absolutely. And no, it is. And again, I had an uncle that was a big, big coin dealer, and collector. And that was his passion in life. And he knew everything there was to know about every coin ever made. I mean, maybe you need to go out and buy pennies, the 2025 penny, since it's all going away now.
Right,
Maybe
before
in
they're all
30
gone.
years, I
Yeah.
guess that'll be the next big collectible, the last penny ever made.
Yeah, it is funny. I did I'd had a little penny collection when I was a kid, and with my older daughter, kind of gave it to her, and we continued building it when she was young. And yeah, when they decided they were going to cut the penny, I'm like, I think that collection has just all of a sudden gotten a lot more valuable.
Yeah.
A, because they're not making anymore, and B, because those old pennies are copper. Yeah, unless you've got the
Absolutely.
World War II penny that was steel for a little bit.
Oh, yeah.
All right, but my point there was really just trying to underscore what you were saying, Lance, which is even a big silver bull like me is saying, look, we've had it so good for so long. Time to exercise some prudence here. Just the charts are suggesting that a pullback is quite likely. Not saying it's guaranteed, but again, when you're faced with those probabilities, just to be blindly long, to me doesn't seem like too much of a prudent strategy. You should have some
Yeah.
defenses in place. And of course, the simplest is just taking some chips off the table, right? As
Yeah.
Lance always tells us. But I did want to let folks know too that I had put on a hedge. This is not personal financial advice for you. So obviously you should talk to your professional financial advisor to see what might be right for you, given your current positions and all that stuff. But you know, I am putting some defense into the mix, although I still have a lot of offense on the field.
Yeah. Of course, and as you should. So again, like I said, we're still long our metals, and we're just doing a little bit of rotation in the portfolio, just keeping risk balance, and the portfolio is doing fantastic. That then
Right.
nothing wrong with that at all. So again, if we get a rotation in the markets, there's some things that we've been allocating some assets to over the last couple of months that should do extremely well.
All right. I want to, we'll get to that when we get to your trades about kind of what's on your target list. And it's interesting that you mentioned Bitcoin there. Real quick, just to get back to the conference for a second. There were a couple, Lance, it was actually a great event. And I took some good notes out of there that we'll talk about near the end of this. But for me, the most meaningful part of it was the vast number of, two things. The quality, the caliber of people who were there was just off the charts.
Yeah.
And it was so interesting. It was such a wide variety of people. I mean, we had people who were scientists, people who were doctors, people who were entrepreneurs, people who were, oil men. There was the woman there who was the actress slash producer. I mean, such a well-heeled and well-accomplished group of people. So again, congratulations to RIA for cultivating that type of following. But people were extremely generous in coming up. I think you got a fair amount of this too, but
Yeah.
coming up and just saying, how much they appreciated what we do and how much sort of this financial education has really helped them become more successful investors. And also to a certain extent, how people have really come to look forward to these conversations that we have here, Lance. One, to get educated about what's going on in the markets, but also just get some of the life advice that you don't really get elsewhere in the world. And I mentioned this briefly when we were on stage, but I had two quick stories to tell. One was the young gentleman who I think handed both you and I handwritten notes saying how
Mhm.
much he appreciated what we did. And of course, we're like,
Who does that?
who does that anymore? I mean, this kid was certainly raised right. His mom definitely needs to get some flowers in the mail. Um, but said some very nice, kind things. But he said, my wife really wanted, she pushed me to come to this conference because I follow you guys so closely, and she, when I listen to you guys every week, she asks me, "Oh, okay, you're gonna go listen to your boring guys now?"
Exactly.
And it's so funny because I think probably a lot of people watching probably have that same experience where the
Yeah.
time they're listening to us, their spouses maybe rolling their eyes a little bit, saying like, "Oh my God, you're listening to these guys just talk about money and riff on life, how boring." But somewhat in her and our defense, his wife, I think English was her second language, so maybe she doesn't, pick up a lot on the jargon that we use. So I can understand. But anyways, Lance, like I said on stage, I'm totally happy to be your boring wingman any day.
You and me both. This is one thing because that actually struck me, and I was thinking about that after the fact, which is, isn't it interesting, right? From the standpoint, we talk about this K-shaped economy. And if you really dig down into the K-shaped economy, yes, there's some bifurcation in the markets because of, things that happened, post the pandemic
The
shutdown. We
COVID.
sent
Yeah.
checks to households, those type of things. There's certainly some of that there, but there's a big chunk of that, issue. And when especially when you talk about the millennials and the Gen Z in particular, they're like this term financial nihilism has popped up over the last couple of years, which is complete nonsense.
Right.
But
Which is screw it, right? Like this,
yeah, just screw it. I'm just going to invest. I'm just going to take the most risk and all those type of things, which we all know, right? Turns out badly at the end of
right.
the day. And it's interesting that people find this subject so boring when outside of your marriage, probably finance is the most important thing in your life, right?
Yep.
If you get your finances under control, all the other problems take care of themselves. Home affordability takes care of itself. The ability to live whatever kind of lifestyle you want to live will take care of itself. But yet that's the thing. We don't want to listen to how economics is so boring, finance is so boring. It's just so fascinating to me because it's such an money is such an important component in our daily life, yet we pay literally no attention to it on the most part.
I know. And this, I mean, this could be a whole rant in and of itself, but this goes to the lack of financial literacy
Yeah.
in this country and in much of the West. And we've sort of I don't know if we told ourselves this or been convinced of this or whatever, but it's that it's mathy. Math is hard. I don't want to pay attention to it because it's hard, and I'll just let other people think about it, or what'll be is what'll be, and I'll just kind of keep my head down.
Yeah.
And obviously, we know no strategy is a terrible strategy, right? And what's crazy too is like when I talk to people, especially young people, about financial literacy, I'm like, look, all the skills you need mathematically, you learned in like second grade, right? I mean, it's not that hard. You don't have to be a calculus major. Yeah.
Yeah. And, and it's interesting. Like if you take a look at some of the highest trending topics on social media, um, it's like stupid pet tricks, followed probably by health and fitness. People want to look better about, they want to feel better about themselves. They want to lose weight. They want to diet. I mean, like on my feed, and this is partly because I'm interested in this stuff. But on my feed, like every other video is, high protein intake, diet tips, those type of things. And I'm in the finance business, but there's very little good quality financial content that actually comes.
Well, I think quality was the key word there. So I'm not on TikTok, but the TikTok videos I see around money, and I believe there are a lot of them, but they're all like get rich gimmicks, get rich quick gimmicks, right? It's like, oh, fold your money this way and it'll multiply. Or the dude who was talking about taking out the business loans to buy Rolexes and flip them, or what? I mean, it's scam
Terrible.
stuff.
Yeah, terrible stuff.
Terrible
But yeah,
stuff.
it's just interesting. I mean, we pay more attention to food and exercise, which is important. Don't get me wrong. I mean, you and I talk about health and fitness and how that's very important to, your future outcomes. Wealth is great, but if you don't have any health, it's what's the money good for, right?
Right.
If you can't do anything with it. But again, we just pay so much attention to our health, but we pay such little attention to our wealth. And I just think it just fascinates me.
I'm going to push back on that too, because I don't think a lot of people on average pay attention to their health. I think they're watching those TikTok videos because they've got beautiful people with abs in them, right? And there's a hope and aspiration that maybe one day I'll do that. But I think they're watching that and then they're door dashing Domino's.
Yeah, but yeah, you know what? I'm not going to argue the point. So I think
Yeah, yeah. All right. So one other story I want to tell, and I did get this gentleman's permission to share it. So the night before the conference, uh, you guys did sort of a VIP cocktail type party, and I ended up kind of closing it down. And I was talking to a couple there. By the way, I also should say too, real quick. Um, I was also really encouraged by the number of younger guys who were there, and I'm talking guys in their late teens, early 20s. They came with their parents, and I asked a couple of them on the side, like, "All right, are you getting dragged to this thing?" And they were, no, no, they were like really interested in this. I'm following this. I'm planning to be an economics major or whatever. So it really did give me heart that there are members of the younger generation for us older guys to pass the torch to in terms of financial literacy. But anyways, so I was talking to a lot of people during the night, and the place is closing down. And there was a guy standing right next to me, and I was like, "Look, I'm gonna have to get out of here." And as I was walking out, he said, "Hey, look, I just want to walk you out. I'm not gonna slow you down. So I just want to tell you how much listening to you and Lance has really changed my life." And he said, let me just quickly break it down for you why. And he talked about how his mother had gotten very old and ill, and he was having to manage her money for her. And his father had managed the money in a very particular way that was probably really overly conservative, like CDs and type of things like that. And the CDs she was in weren't really yielding anything, but he didn't feel like he could change the approach while she was alive because it would stress her out, right?
yeah,
She was like, "Look, this has always worked. You're deviating." He didn't want to just give her that stress in her last years. So she passed away. He inherited his half of the money, and basically said, "Look, at that point of his life, he wasn't sure if he was going to be able to retire." He worked a state job, and he said, "Look, this is my last chance. I don't have time in my life to go through another cycle if I don't manage this money well." And he ended up reaching out to RIA. He ended up working with John Penn
Yeah.
at your place there, Lance,
Awesome guy.
and said that the basically the performance since he's done that, and look, performance no guarantees, it differs for everybody. But he said now retirement is not even just a possibility for me, it's becoming a probability. And I cannot tell you like the psychic weight that has lifted from me and how that is changing my life. And so, yeah, I just thanked him for sticking around and sharing that story with me and telling him, yeah, look, that is the absolute best feedback that guys like you and I
Yeah.
can receive, because that's exactly why we're doing what we're doing, right? I mean, we're trying to change lives for the better. I don't pretend that we're successful in that all the time, but when we do really give somebody a pathway to a better future, man, does that feel good.
No, and look, you and I spend a lot of time talking about the price of silver, the stock market, and all those type of things. And I've said this on my radio show before, in my YouTube channel, which is, what I do inside of our company is the least important thing. And, that's just the management of the assets. That's all I do. I just try to make sure the money grows over time. That's my job. But that's the least important part of building your retirement and getting to that goal. And again, John Penn I've worked with hundreds of financial advisors over the course of my career. And, I can't tell you how blessed I am with the group of people, Richard Rosso, Danny Ratliff, John Penn, Jonathan McCarty. These guys are rock stars in terms of the financial plan. I've never worked with guys as smart and dedicated as these guys are. And when it comes to financial planning, you can't ask for anybody better. But that's that financial plan, which everybody, it's kind of like, it's what I was talking about a minute ago about we don't pay attention to finances. The fact that people don't have a financial plan is beyond me, because that's the blueprint for building wealth. Once you have that
Exactly.
financial plan in place, then you know how to invest. And it just fascinates me that people invest money with no plan. And it's like building a house without blueprints. You'll get a house, but no telling what it's going to look like. But you don't realize how much when you do that way, when you don't have that financial plan in place that dictates how much risk you need to take, tells you, what your savings rates need to be, those type of things to reach your goal. You wind up taking on a tremendous amount of risk in your profile, because all you have to benchmark against is just chasing the market,
Right.
rather than looking at your financial plan and saying, look, I need 6% a year. That's what I need to hit. That's my number. If you don't have that, you just start chasing markets. You take on this exceptional risk, and then you have the corrections that eventually will come that winds up setting you back years or even a decade from your goal, because you didn't have that plan to work off of. And that's one of the most fascinating things that I find about individuals when I talk to them is like, oh yeah, I'm a DIY investor. I'm like, that's fantastic. Me too. I'm a DIY investor. And I said, how do you, how are you investing in what are, kind of what your goal structure is like? Oh, I just look to beat the market every year. I'm like, that's a terrible plan. They're like, why? It's like, well, what happens when the market's down 50%? If you're trying to chase the market on the upside, you're going to beat the market on the downside too. And they're like, I never really thought about it that way. I'm like, yeah, that's, this is why you and I spend so much time talking about risk management, taking profits. I don't care what assets you're invested in. You can make money in it. It doesn't matter. But, understanding the risk profiles that you're taking, understand how to manage that risk is what's important. Because again, price volatility is not risk. And this is a big mistake that investors make. They go, oh, well, I look at volatility as a measure of risk. Volatility is not risk. Risk is the potential of destroying your wealth. And if you lose your wealth, you're out of the game. You're done, right? It's like going to Vegas, betting all on black, and it turns up red. You're done. You go home, right? That's risk. And that's what you need to be mitigating against in your portfolios.
Well, and so as we've talked about, understanding risk personally is really the most important thing that you need to do here, because you may find I don't need to get 8% or 9% a year to hit my goals. I only need 4, right? And so you can get to where you need to go by the time you need to get there with an awful lot less risk, right? So all of a sudden, the chances of you being knocked out for a decade or more, they drop precipitously, right? You can sleep much better at night, right? The key thing is having the plan, but then also, as you've said in the past, Lance, is revisiting that plan and updating it. I mean, how many people do you know? Yeah, I have a financial plan. Okay, great. When do you put it? When did you put it together? Oh, about 8 years ago. Right? Well, when's the last time you updated it?
Never.
8 years ago.
When was the last time you looked at it? Eight
Yeah.
years ago.
Yeah, and it's so funny because like, with the advisor I probably have the majority of my assets with, they use a financial software for financial planning. And I was calling them so often to run scenarios on it. They just said, Adam, let's just train you on the software. Here's the software.
Yeah.
Use it yourself whenever you want, right? And so I just geek out, every couple of weeks to get on, I play around with stuff, right? So,
No, we do that as well. So, we update our financial plans for our clients every single year. We have reviews with them, those type of things. But they have access, all of our clients have access to their financial plan and they can go online and we have, listen, it's funny because I hear from clients like they're up at 2 o'clock in the morning. It's like, oh, I was laying in bed and I had this dream about this. And so they'll get up and log in and start messing with their financial
mhm.
plan, for whatever reason. And, I think it's fantastic, right? When you're that
That's me, by the way. I'm that type of client. Yeah.
yeah, yeah. But when you're that engaged with your money, your success rate goes up dramatically
Yeah.
because you start understanding things. You make a really good point a second ago. I just wanted to encapsulate that for
Yep.
listeners, which is he said, look, if you're I'm going to use an easy number. We'll use 4%. So let's say your financial plan says you just need 4%. Who wants 4%, right? That's boring. Market's up 20%. So what if I got five? Okay, just and again, we're going to keep this just math wise.
Yep.
So to go from 4 to 5, that's a 25% increase in the rate of return, right? So I just want an additional 1% gain each year. That's a 25% increase over your 4% goal.
Yep.
The problem with that is the amount of risk you have to take for that 1% additional gain goes up by almost double. It's an exponential increase in risk for every percentage point rate of return over your goal that you need to make. And this is why not having a financial plan is so detrimental to your future outcomes because you're kind of just throwing darts in the dark, hoping to hit the dartboard. But a financial plan will help you navigate that risk profile that you will drag yourself into unconsciously by not having a plan to work off of. Anyway, I think we won't
Okay.
beat that horse to death, but there you go.
Yeah. Okay. So, folks, we're going to get back to the discussions of the markets. And Lance, we're going to get to your South Park post in just a second here. But the reason why we're spending so much time on this right now, folks, is because of what Lance said at the very beginning, which is this is a market where correlations have largely gone to one, and the rising tide is rising, just about all boats right now. And this is where people just don't want to hear about risk mitigation. It's boring. It's not sexy. It's not fun, right? But this is where it matters the most. The moment that people start taking losses, they're going to care. This is all they're going to want to hear about. How do I mitigate risk? How do I get back to where I was, right? But the problem is that the information has much less value then, right? So we're just trying to hammer it home right now while times are good and the sun is shining. This is when you want to thatch the roof. This is when you want to think about defense. All right. So Lance, last year, at the beginning of last year, you wrote a seminal post called Curb Your Enthusiasm. And it was all about, setting expectations for the year. I would say, you might feel differently. I would give that post maybe a B for
Hmm.
how the year turned out.
Yep.
Because definitely it started out really volatile and the piece was really timely there. Then we kind of went back to the old
The
look,
old playbook.
market's just grinding higher and
Yep.
the Teflon market, nothing,
Yep.
nothing sticks to it. This piece is sort of a revisitation of Curb Your Enthusiasm. You're now picking a different TV show, South Park. Um, Let me just hand you the baton. You can tell people why you wrote it, but I do believe it's in the spirit of what we've been talking about here.
Yeah, yeah, no, and again, so in terms of curb your enthusiasm, the point of that article is that all Wall Street analysts were extremely bullish, and nobody was looking for any type of volatility. And the point of that article was be prepared for volatility. We think
Yep.
we thought the market would end up about 10% for the year. We did 17. So yes, get a B rating on the article for missing returns by 7%. But we did have volatility. I had a 20% decline kind of mid-year. Now everybody forgets about that because the markets did so well, but everybody forgets about the volatility that happened in between. So, and I think that is a good kind of backdrop when thinking about 2026. So we'll just share some charts with you from the article. Right now, Wall Street forecasts for 2026 are all expecting near 15 to 16, 14, 15, 16% gains on average. So, I mean, they're very optimistic about this coming year for a whole, and again, this whole premise is based on economic reflation, which is a surge in economic growth with no inflation. So
Mhm.
that's kind of the premise for this year. The Fed's going to keep cutting rates. And over the next couple of weeks, we're going to revisit, you and I are going to revisit this article, not this article, but I've got a couple of articles coming out over the next couple of weeks talking about this reflationary cycle and the risk that we need to be paying attention to relative to that reflationary idea,
Yeah.
and what
And
we
just
think
to
can
note,
happen.
this reflation without inflation is what the
Yeah.
administration is selling hard right now.
Yes, absolutely. Everything's going to be fantastic. You're going to have economic growth, higher wages, all going to be great, but no inflation. So, um, we'll see how that works out. But, and again, that's why I'm writing some articles on this. So we're going to rehash this topic a couple of times here over the next couple of weeks
Yeah.
because I think it's really important for positioning portfolios for the rest of this year. So again, everybody's very
Hey,
bullish.
Lance, do me a favor. Just magnify the chart if you can, if you're going to bounce through a few more.
Yeah, but, we're going to clip through a few more here.
Yeah. Just
So
thinking of the
again,
boomers like me, the guys like me whose eyes are going.
no problem. So let's talk about market structure. As kind of the first, this article kind of goes through three phases: market structure, and then kind of the underlying fundamentals. But one thing we've had over the last 3 years are these exceptionally large outsized returns, which now put us about 18% above the 3-year moving average, and that's an inflation adjusted real return basis. So we're the markets have had exceptionally high rates of return, and that's very hard. That structural nature of the market is very hard to maintain. In other words, the odds of having 4 years, not saying that it can't happen, but the odds of having 4 years of above average returns is going to be much harder to accomplish simply because of the natures of the markets. And again, this goes back to the reversion to the mean. And again, it's not just the stock market, it's silver, it's gold, it's precious metals, it's any asset, it's mid cap, small cap. You kind of look through markets, a lot of these markets had exceptionally high outsized rates of return over the last few years. And that reversion to the mean becomes a function of process over time. It's a structural foundation of the market. That gravitational pull will create that reversion. Now, does that mean that you're going to have a 50% decline in the market? No. What it does mean, though, is that returns could be substantially lower over the next couple of years. Maybe we're doing 5, 6% rates of return in assets versus 18, 20, 30, 40, whatever they are. You're going to have that reversion in process. So structurally, something very much to pay attention to. This is the deviation of valuations for the stock market. Again, this is using the Shiller Cape ratio, but this is the deviation of valuations from the long-term exponential growth trend of valuations going back to 1900. We're currently at about 167% deviation from that long-term exponential growth trend, and we've only seen that peak back in really around 1900 was the last time we were even close to that peak, and we went through a 20-year secular bear market during that period before we had the run up from 1920 to 1929. So again, this is not something that you go, oh, market's going to crash tomorrow. That's not what that means at all. These valuation levels, and you can see here, even back in the early 1900s, you kind of peaked at those high levels over about a 10-year period before the markets actually started going through a big mean reverting process. So these things can last much longer than you think, and this is why it's important not to immediately react to valuations, because valuations in the short term over the course of a year are simply just a reflection of sentiment. So everybody's very bullish about the markets, everybody's very optimistic about the markets. That's all fantastic. But, you know, valuations longer term do tell us that the risk of reversion are becoming much larger.
Hey, can I just say one thing here?
Yeah.
So, uh, it, right now, there are charts out there. You've shown a number in the past that show
Mhm.
that forward returns, 5 year, 10 years, are projected to be negative for the markets given today's valuation levels, right?
Right.
Um,
Like this one?
like that one, exactly like that one, right?
Okay.
So go back to the other chart for a second, the one you were on before. Um, so, a lot of people who are watching here, Lance, are older, right?
Right.
Um, we don't know what's going to happen in the next 10 years, but let's just assume that that prediction is true. And let's even just assume that it just goes sideways, right? The market
Mhm.
just goes flat for 10 years.
Sure.
Um, you know, there's a lot of people who don't have the ability to recover from a lost decade, right?
Right.
And you're showing here that, like the 1900 one, that was a 20-year bear market. And a 20-year bear market is actually more the norm than not, looking at this chart here, right?
Well,
And so,
yeah. So, just real quick to your point,
yeah,
1900 to 1920 was a secular bear market. Then you had a secular bull market from 1920 to 1929. Then you went from 1933 to 1953 before that bear market ended. So there was another 20 years. Then you went from 1962 to 1982 in the next bear market. These bear markets last just about as long as the bull markets last. So again, if you take a look at 2008, that was the bottom of the secular bear market from 2000 to 2008. It then took 13 years basically to get back to even in terms of returns. So you say, okay, well, from 2013, if I have 15 years to 20 years, in a secular bull market, we're getting closer to the tail end of that rather than the beginning, right? So, to your point, don't dismiss these periods of low returns. That doesn't mean returns are low every year. You're going to have some really good years, but you're going to have some down years, right? So think about 2000 to 2013. That return was zero on an inflation adjusted basis, but you had two 50% corrections in that process, right? And
right.
that's what really damaged a lot of people that were trying to retire in 1999, 2000, they didn't retire.
Yeah. And that's where I'm going with this, which is, look, folks, is this the peak? We don't know. Could the bull market last for another 10 years? Yeah, sure, probably. I mean, possibly.
Yeah.
Um, the point is, if you're 65 and we're just about to enter a 20-year bear market, you know, that's that's really unpleasant. Like, a lot of your retirement dreams are
Mhm.
going to get wrecked by that, unless you're positioning yourself in such a way to try to not be as vulnerable to the downside of that cycle, right? And I'm just guessing, Lance, like, in at 1900, the folks who somehow managed to avoid the worst of the downdraft, just on a relative basis, were way better off than the vast majority of the rest of Americans here. And so,
Yeah.
yes, in this type of period, an active investing approach is probably going to work much better than a passive investing approach. And you may actually be able to make some good money during a
Yeah.
period like this, if you catch the good years.
Yeah.
And look, I'm not trying to sell fear. I'm not trying to tell everybody, hey, you gotta sell everything because it's the top right now. I'm just saying, probabilistically, this chart is saying at some point in the not too distant future, it's probably more likely than not, we're going to enter a prolonged bear market at some point. And if
Mhm.
you're approaching retirement there, you want to make sure that you are taking steps at a minimum to try to, position your portfolio to not take 100% of the downside.
Right. And look, and this is why it's important to monitor we're talking about the market here, but if markets begin to move into a bear market, it's going to be every asset class that went up at the same time is going to go down at the same time. So because money's going to rotate within markets. So whatever asset you're in is like, oh, I'm not in stocks right now. I'm in silver and gold. Fantastic, great. You're having an awesome run in that. But when money starts to leave the market, it's going to leave the market across the board and it's going to look for the most undervalued, risk averse asset, which right now would be treasury bonds because they've been unloved now for about 4 years. So, those you're going to start to see that rotation of money. If it occurred tomorrow, that's what you would see happen. Now, the next bear market, secular bear market period may not start till 2030, right? So, we may have 5 more years of this type of a market and life is good. Everybody's happy. We've got data centers, we've got all this other stuff going on. But what we do know historically, going back to 1900, that these markets cycle about every 15 to 20 years. And the upsides are fantastic and the downsides are brutal. And you're just going to have to be able to navigate through that. And again, I was talking about real quick, Adam, this is the point about valuations. And again, a lot of people are saying, "Oh, valuation," and this is why I want you to be really careful when you take a look at valuations and talk about them, is because everybody looks at valuations goes, "I got valuations are high." Everybody's been saying the market's going to crash for 3 years now, and it hasn't crashed. So obviously, valuations are wrong. Um, the problem is in the short term, and this is consumer confidence, and this is consumer confidence of higher stock prices in the next 12 months overlaid against the rolling 12-month PE ratio. And you'll notice there's a very high correlation. So, in other words, all valuations tell you in a 12-month period is what consumers think about stock prices. That's it.
Yeah.
We're willing to overpay for valuations right now because we think asset prices are just going to go up. There's no risk in the market. It's fantastic. Now, this was the chart you were talking about. This is forward 5 year real returns based on Cape valuations. So at current Cape valuations, the forward 5 year return from today is somewhere around zero. That's what history tells us historically going back to 1900. Now, does that mean it has to happen? No, but whenever you've had these levels of valuation, 4 and 5 year returns have been they I tell you what they ain't 20% a year.
Yep.
So, I think that we've milked a lot out of, kind of where we are. But again, I think you have to be more cognizant about what you're paying for asset prices right now.
Yeah, and just to add to that, and Lance, while I'm talking, if you can expand the size again a little bit, I think maybe it's
Sure.
shrunk back a bit. Um, but let's say you're somebody who's listening closer to the administration. You say, you know what, Lance, I actually think the economy is going to do great this year. I'm
Mhm.
picking the over on the GDP. I think
Yeah.
maybe we could get 5% GDP growth.
Yes.
While stock prices are a function of earnings expectations, so earnings go up, in general, that should be supportive of stock prices. This goes back to valuations, right? It's price versus value. And right now, prices are extremely deviated in terms of a multiple, in terms of average multiples that we've had in the market. And my point here is you could be right, and we could actually have an economy that grows faster next year. That doesn't guarantee the stock market's going to continue to go up. In fact, you could have a stock market correction or pullback even with a growing economy.
Absolutely. And you brought up and you started that whole statement with exactly the right issue, which is earnings expectations. This is the deviation of earnings. And over here on the right-hand side, this is going through 2026 earnings expectations. The expectations for earnings growth this year puts earnings growth at the highest deviation from the long-term earnings growth trend going back to 1900 ever on record. We're at 44.4% deviation right now. Tech bubble was 35.87. The real estate bubble is 42.45. So, even in we had the liquidity bubble going into 2015, we weren't there. And even in going into the pandemic, we weren't anywhere near these close to that. So, you've got very high expectations for earnings in an economy that is looking at slower employment growth. I was just posted a chart this morning talking about real disposable incomes are declining, savings rates are falling. That's so falling savings rates, are good for economics in the short term because that means people are spending money. But if you take a look at GDP growth over the last 2 quarters, it's been almost entirely a function of tariff issues, which is net imports and exports. So when you take a look at net exports as a percentage of GDP growth, it's normally doesn't show up. It's a very, very small fraction of GDP growth. It's been very big parts of the last 2 quarters. Now that's going to eventually reverse. Most of that's been gold exports to get ahead of tariffs, and worrying about future tariffs. This recent tariff threat over Greenland was another good example. Those gold exports have very little to do with the economy, but it has a huge impact on what's happening with the GDP calculation. So you're getting this, exceptionally strong growth in something that actually has nothing to do with actual economic growth. And
Mhm.
and I think the payback on that is going to come this year. And we may see slower economic, I think we may fall short of these economic growth expectations people are hoping for.
Right. And I think that came up in the live weekly market recap that we did on stage. if memory serves correctly, you were taking the under
Yeah.
for the year. Yeah.
And
Right
again,
now,
I
yeah,
I can,
your eyes are open to that potentially changing, but right now you're starting with an under.
well, and look, I think the way to couch this is I think we just need to go into this year with kind of wide eye, eyes wide open to a degree. Is like, look, the bullish case is great. The bullish case is awesome. That's the easy part of the strategy, right? I'm invested. We're over allocated to equity risk right now. Portfolios are doing great. I don't have to do anything with the bullish case. If the bullish case comes to fruition, I'm fine, right? It's kind of like I'm driving a robot Tesla at the moment. My hands aren't even on the wheel. We're just cruising down the freeway. Everything's fine. So the only thing I have to worry about is if something goes wrong. And so that's why I'm spending a lot more time here over the next 3 weeks focusing on the potential risk
Hmm.
that could occur because if the risks don't occur, I'm fine. The markets will do great, my portfolios will do fine, my clients are happy, awesome. But what I've got to be prepared for is the thing that goes wrong so that my clients don't have heavy impacts because of that.
Yeah, and folks, this is, in my opinion, what you want in a good financial advisor is you want somebody who is kind of neurotic when times are going really well, for exactly the reasons that Lance mentioned. And similarly, you want somebody when everything looks awful, somebody who's trying to look for the light at the end of the tunnel as well. Hey,
Exactly.
real quick, just because you
Sure.
mentioned it, did you see the headline yesterday that a couple of guys basically did their version of the cannonball run in a Tesla with full self-driving? They had the car drive them from LA to New York, and they didn't touch the wheel the whole time.
Really? No, I did not see that. That's awesome though.
Yeah. Yeah. So yeah, it just shows that look, this technology age that we are hurtling into is continuing to improve at an exponential rate.
Yeah.
All
Also
right.
saw a headline yesterday that Elon Musk was taking safety managers off of the self-driving cars in Austin. So I'm not sure what that means, but
Well, actually, I saw an article today, and this is just a headline, so it could be wrong. They're now in follow cars, so they're
yeah.
not in the car itself,
Okay.
but they're in cars behind just to make sure that nothing goes wrong.
Gotcha. Gotcha.
Yeah,
Gotcha. So yeah, I'm still look. I At the end of the day, I'm still kind of a control freak. So I'm
yeah,
personally not quite ready for robocars. I'm sure a lot of you are. Hey, YOLO, you only live once, right?
right, right. What's interesting though is apparently auto insurance companies are now
Mhm.
offering discounts for Tesla owners who use the full self-driving because statistically the cars get into accidents less.
Well, yeah, but you
So
don't have a lot of history on that. That's the
you
only
don't you
problem.
don't have a lot of history, but it
Yeah,
is interesting, which is
it is
if
interesting.
if they indeed prove it. And look, uh, I mean, I'm like you, Lance. I'm kind of a
Mhm.
dinosaur and probably will never feel fully comfortable with my hands off the wheel. But I also know that, you ask humans if they're, people, if, are you an above average driver? And about 87% of people say yes, right? Which mathematically isn't possible.
Right.
So I'm going to bet that the collective, wisdom of the technology does drive more
Hey,
safely than the average
you
American.
know what? And here's the bottom line of all that. I am all on board with everybody having a robotic car if it gets rid of traffic in major cities.
Yeah.
You know,
Well,
I am all for it. We may go 30 miles an hour everywhere, but at
yeah.
least, these when people have accidents on major free, especially here in Houston, right? It just backs up traffic for an hour. So I'm all for
Yeah.
it. I'm all for it.
And not to turn this into an Elon love fest, but I mean, I mean, the research totally shows too, like merge lanes and things like that. These are
Mhm.
where the big bottlenecks occur, and they occur because people aren't moving efficiently, right? It's you just trust the car next to you, so you slow down too much and whatnot, right? Where if it's all being kind of controlled by, the hive mind of the AI, everything can move as efficiently as possible. So you probably won't get the 30-mile an hour crawl. But you also add things like the Boring Company into this, right? Where, we can
Yep.
have these kind of underground express routes and stuff like that. Like who knows? Traffic might become an artifact of the past in 10 years.
Hey, I'm 100% all for that. All right, back to the topic.
Back to the
Uh,
topic.
this is the World Economic Outlook from the IMF for 2020. This is as of October 25 for 2026. And the interesting thing is that Europe and emerging markets, they've been on fire lately. They've been doing great. Small caps and mid caps have been on fire. Now they're underperforming pretty dramatically here on Friday, but they've been doing very well. on this idea of this economic resurgence, yet the IMF is projecting 1.1% economic growth in Europe and 2.1% growth in the US. That's well below what Wall Street's currently expecting. So,
Yeah.
so again, I'm not saying that's the case, but just fundamentally, we're now moving into the kind of the more fundamental structure of the market out of the structural side of it. I think that's something worth paying attention to because economic growth is where revenue and earnings come from. Without economic growth, you can't have revenue and earnings. And that's going to be the big watch for this year.
Yeah, I don't think I'm going to be able to. Well, I don't think the probability is super high, but folks, I am going to do my best to try to get somebody close somewhere to the administration. Um, my dream would be Scott Bessent, and actually, without outing them, one of the people I interview is actually friendly with Scott Bessent and has said, "Hey, Adam, I'll pass your request along to them."
Okay,
But I want to
awesome.
get somebody from the administration who's close to the economic side of things to come on here and just make the case for the 5 to 6+% GDP growth this year.
Yeah.
Not saying I'm going to be able to do that, folks, but just letting you know I'm trying my best. And if anybody watching has a connection there, please just email me at adam@thoughtfulmoney.com and I'll respond right away.
Yeah, absolutely. So kind of moving into more of the kind of the fundamental, kind of backdrop of this. Household equity ownership of the S&P 500 is at all-time records. So you've got, it's interesting. We talk about this, right? We say, well, only 20% of the market is, 90% of the market's owned by 20% of income earners, but yet household equity ownership's at record highs. And this has a lot to do with passive investing as well as, 401k plans, which are,
Yeah,
which by the way, as we've talked about before, 401k plans are a very small factor in the overall market. Only 25% of employees actually use their 401k plans.
right.
So it's sad. All right. More people should be contributing to a 401k plan, but it's not as big of a factor as a lot of people make it out to be. But passive investing by individuals at the household level has risen. In fact, one of the bigger concerns right now, I think for 2026 is that in 2025, you had 1,000 new ETFs come to market. So every year we've just had an explosion in new ETFs come to market, but last year it just went surging off to the moon. And a big majority of those were leveraged and single stock leveraged ETFs. Um, the issue with that is that this is kind of reminiscent of what we saw in 2021 when we had this big rush to get SPACs to market. We couldn't get companies to IPO fast enough, so we started doing SPACs and all kinds of other stuff to meet that speculative demand in the markets. And you're seeing that again with these ETFs. ETF providers are happy to provide you an ETF. If there's even an incremental piece of demand for something, they'll throw an ETF out there for you. And the problem with ETFs though is that you need about $10 million in AUM, assets under management, just to make it viable to launch an ETF. You need about 50 just to break even on it. And to make some money with it, you really need about 100 million under management. So the point about that is that a lot of these ETFs, especially the leveraged ones, are going to wind up going away because of the leverage. And again, we saw a lot of 2x leveraged ETFs come out. We talked about recently there was this push to do a 5x leveraged ETF.
Right.
A
Thank goodness
lot,
they put
thank
that one
God
on
those,
pause.
yeah, thank God those didn't go through. But just as an example, let's say you've got a 2x leveraged ETF on some asset, and it's got a limited amount of assets under. This is why I always want to take a look at the both the volume of the ETF, how often it trades, and also look at the underlying assets under management. But let's say you've got a leveraged ETF, which is using options to create that value. And if that stock price goes nowhere for a period of time, in other words, whatever it's tracking goes nowhere for a period of time, the optionality inside of that ETF will continue to erode the value of your ETF. And eventually you could wake up one morning and they close the ETF because they're simply not profitable and they'll close that ETF on you. And you may or may not get money back depending on where it closes. There was recently a ETF. It was that was issued, and the notice was sent out. It was a 2x leveraged ETF, and a notice was sent out to owners of the ETF that the value of their ETF as of that day was 0.0000.
Oh, geez.
So, it can happen. And so just be careful. But the bigger point here is that households are all in. Everybody's in the pool in terms of either equities or precious metals or whatever it is. They're all invested. They're 100% in the markets. And because of that, Wall Street is rushing to get more product because it's an asset. It's a land grab for assets, right? If I can
Right.
just get something out there, I can get some assets and make some money. So there's this big rush to get out there, which means you're getting poor quality product coming to market. Your risk is going up exponentially. And when this reverses, that kind of adds the fuel to the fire because of forced liquidations that will occur as a lot of these things have to unwind, delever, and basically close up shop. So this is one of those structural underpinnings that is not, this does not mean markets are going to crash tomorrow, but this is that fuel to the fire, right? That's the kindling and that's the lighter fluid, kind of on the coals. All you're missing here is a catalyst for that reversal. And same thing here. This is margin debt. So there's been a lot of analysis about margin debt. This is margin debt as a percentage of real disposable income. And the reason I
Hmm.
did this one is there was an article by Bloomberg. I think it was Simon White did an article in Bloomberg looking at margin debt as a percentage of GDP. And I was looking at that saying, well, that doesn't quite measure what's going on within the markets because
Right.
economic growth comprises a lot of things, right? You have imports, exports, you have government spending, you've
Right.
got household personal consumption. So
And
maybe
it can be
there's some value
distorted
there.
by like what's happening with gold with the
Yeah,
tariffs and stuff.
yeah,
Yeah.
yeah. And you get some bifurcation there. So, but if you take a look at margin debt versus real disposable income, so this is what individuals theoretically have left after they pay taxes on
Right.
their money.
This is not dissimilar to a home price to local incomes chart, right?
Exactly.
Yeah.
And so what this is suggesting is that individuals have run out of capital to invest and they're now, so my real disposable income, I can invest out of that. I've now used all of that to invest any of my savings I've now invested, and now I'm turning into margin debt. And that's the highest level that we've seen ever on
Yeah.
record. Now,
I
does
think this
that
is one of the scariest charts you ever showed me.
again, this is bullish, right? Margin debt going up is bullish because it provides buying power for the market. What's
It's
important
bullish
is
while it's going up. Yes.
correct. It's also fuel for the fire when it goes down because that's the liquidation event on the other side. So again, just one of those structural issues. Nothing doesn't mean anything today, but I think this adds more of that fuel to the fire, so to speak, that if there's a catalyst that ever shows up that ignites the sell-off, there's plenty of fuel behind it to make it a bigger sell-off than a lot of people are expecting.
Okay. Hey, can I make one corrective comment here real
Sure,
fast?
of
Can
course.
you go back to the pull up the chart you had two charts ago? Thanks, Lance. So yeah, here I just in case folks got confused earlier. So these two things can be true at once, which is we can have record high household equity ownership, and we can have 90% of financial assets owned by the top 10%, and that's
Yes.
the stat that's been out there.
Yes.
And the way to understand this is yes, more and more households may be participating in their 401k or whatever. They just might not have that much in it compared to the top 10% of households, which have basically all the wealth. And they own 90% of the stocks
Right.
that are out there to own, and the rest are distributed amongst the other households there.
Correct. And again, if you look at the bottom 50%, they own like 2% of the market.
Yeah,
Right.
exactly. I
They
mean,
barely show up.
basically, the only tie they have to how the stock market is doing is if your company's stock gets hammered and it has to lay you off, then it matters, right?
Correct.
But otherwise, their lives aren't that impacted by what happens in the stock market.
Exactly right.
Yeah. Okay. I guess they're impacted in the sense that those who do own assets are just getting further and further ahead of them, which is,
Right.
something we have ranted about a lot.
Well,
Um,
that's the K-shaped economy that we were talking about earlier.
Right. Okay, so a couple other topics I still want to bang through in the time we have left, but real quick, since we're still kind of on the markets, Lance, do you mind just doing a quick TA and
Sure.
showing where we are right now? Um,
Yeah,
and
absolutely.
what's interesting is we are closing in on 7,000 S&P, as I mentioned earlier. And Lance, it looks like we're going to hit 5,000 gold before we're going to hit
Mhm.
7,000 S&P.
Right.
Gold, at the time we're trading here, has less than $15 to go. Silver is now at 101, just FYI. S&P is down on the day. It's got almost 700 bucks it needs to go to get to S&P is
So we're up.
50 bucks. It needs
Yeah.
50 bucks to go.
Yeah,
Um,
we're still up so far on Friday right now, but
yeah,
yeah.
marginally, right?
Yeah.
Yeah. Okay. But despite the fact that we're knocking on the door of 7,000 S&P, if you go back here, and maybe I need to have my glasses on here, but the S&P hasn't really gone that far since what,
Mm-mm.
October? You've
Right.
got this sort of rising wedge there from the low that we saw in mid-November. But if you go back further, the October high isn't that far away from where we are right now.
No, no, it's not. And Tuesday, so Monday was a holiday, right? So nothing happened on Monday, but on Monday, we were starting to worry about this whole, issue about Greenland. Then on Tuesday, the markets opened over this whole Greenland concern. There was some comments by the White House, maybe about using force or whatever it was. And again, as you and I have talked about before, the White House is very good about using the stick and carrot, and why the market keeps buying off on these announcements of, we're gonna impose tariffs on Europe across the board, over this Greenland deal. Why anybody takes that seriously is beyond me at this point.
It's like Charlie Brown with the football. Like, when is he going to learn that Lucy's going to pull it, right?
Exactly. And yeah, so why yeah, so yeah, Adam, you're absolutely right. Why the markets, respond, like they do relative to these, announcements beyond me. But what it does show you, one thing that we've talked about here before, is that when markets are rising, the reason markets go up, there's only one reason that prices rise, is because sellers are being drugged into the markets. So a good example today, you were talking about silver earlier. So silver's up sharply today, and that's because the sellers of people willing to sell silver today are saying, yeah, I'll sell it to you, but you're gonna have to pay me $100 for it. And then somebody does that. And so the next seller goes, okay, you're gonna have to pay me 101 for it. And then somebody does that. And so the seller sells. But the problem with that is that the buyers are now way below that number. Somebody willing to buy silver or in bulk are sitting much lower than that $100 a share. So in other words, as prices rise, you have a marginally fewer number of buyers and sellers willing to transact that price at that level. The bulk of buyers are sitting much lower. And that's what you saw on Tuesday with the markets. Is buyers were there. They were 2% lower in the markets.
hmm
And we saw retail investors in particular, heavy buyers of S&P 500 indexes on Tuesday. And that's why this week, the Mag 7 stocks have been doing very well. Google, Microsoft, Amazon, Meta, they've been up sharply this week because all that money flowing into passive indexes is fuel. 40 cents of every dollar, as we talked about before, fuels those stocks. So you're seeing those stocks go up because of that buying of those indexes. So importantly, technically, we had a little bit of destruction here. We had this rising wedge pattern, which was great. We broke that bullish trend line on Tuesday. That trend line is now resistance to this rally. So if we get a rally back up here close to the previous highs, we're going to intersect to the bottom of that rising trend line. So that may make it a little bit difficult here temporarily for stocks to get make new all-time highs. We're also on a momentum sell signal right now, which suggests that markets may be a little bit weak going into next week. Also, money flows have turned negative here temporarily because of that sell-off on Tuesday. So we need to see that recover as well. But next week and the week after, we have earnings. We're going to get into the heart of earnings season next week. And then the following week, we get Apple, Microsoft, Tesla, and Meta. So you're going to get a lot of the big boys coming up, not this coming week, but the week after. So over the next couple of weeks, we're going to have about 80% of earnings hit the markets. That opens up the buyback window for this market. And again, so part of this sloppiness that we've seen here as of late is simply a function that you've had no buybacks going on in the market because that window's been closed.
And I was just about to ask you about that. So, how concerned are you about the market's prospects in the next couple of weeks as capital flows seem to be turning negative? The buybacks window is shut or ending, and we're not going to have that marginal buyer back in the market for what, 3, 4 weeks from now?
Well, it's a great question. It all hinges on earnings next week.
On how good they are.
Yeah, well, so Netflix was a really good example. Netflix reported really good earnings. Their revenue growth was good. Their earnings numbers were good. They hit 375 million subscribers. I mean, Netflix is killing it. They're doing really well. But the stock got hit by almost 7% after their earnings because of their forward outlook. So again,
hmm
it's not going to be what these companies report. it's going to be about what they say about the rest of this year. And if their guidance, so two things are potentially, and so here's two of the potential risks. We talked about those earnings being very optimistic for this year. If we go through this quarter's earnings season and outlooks are starting to get cut back, we're going to see those earnings estimates drop. And that's going to make valuations more difficult to justify at current levels. So that may induce some more risk into the markets worth paying attention to. If outlooks are fantastic, awesome, right? Markets are going to do great, and particularly around the AI story, right? So Apple, Microsoft, Amazon, Google, NVIDIA doesn't report till the end of February, so we're going to have to wait for the king of AI to report for another month and about a month and a half ish. So, we've got a lot of stuff coming up that's going to detail that narrative around the AI story, the CapEx spend, the data center build outs, the infrastructure development. That's the things to really be paying attention to here for over the next couple of weeks, because a lot of it will define both the economic growth expectations and earnings expectations for the rest of this year.
Okay. Let me ask you this, Lance. So one of the things you and Michael have been talking about, we talked about this at your conference, is capital rotation.
Yep.
And this year, the big hyperscalers have been weaker than they've been, and we've seen capital flow into mid caps, small caps, other industries.
Right.
And of course, one of the big questions that we've been talking about is okay, is this just a little blip, or is this going to be kind of a major theme for the year? Let's assume for a minute it is a major theme for the year, where the hyperscalers kind of cool off a bit, but the other parts of the market catch fire. Can the market still be up like 15% plus without the hyperscalers, given how big of a chunk of the market share of the indices they are?
No, because the small cap, mid cap stocks in particular, they don't make up that. If you think about where the major assets are held, right, it's mostly in large cap equities. Think about your largest ETFs, stock market, the Vanguard Total Stock Market, the SPY, the VOOs. That's where the bulk of the assets are held. So and again, since those are primarily made up of the large cap stocks, particularly the kind of these hyperscalers that make up a big percentage of that, it'll be very difficult for the overall market to be up that much if you don't have those guys kind of pulling the horse, so to speak. I mean, financials make up a big part of the market. Healthcare makes up a big part of the market. So again, if those guys do better, then a positive return year will be we'll have a good positive return year. We'll be up 8, 9, 10% this year. I think it'll be difficult to gen out another 20% return without the big mega caps driving the lead.
Okay. Now, on an individual basis, you could create a portfolio that has a lot of exposure to these other industries and these
Sure.
different cap sites, and you could have a great year, right? But I hear you saying, and this is the math I was chewing on, it's going to be hard just for the overall indices to perform as they have in the past 3 years if the hyperscalers cool off.
Right. And again, I'm not sure that that's the case, that's going to be the case. If I was a betting man and saying, okay, what do you think is going to happen over the next, 6 months to a year? When I look at the fact that you have emerging markets, small caps, micro caps, small cap growth, dividend developed markets, all shoved in this upper right-hand corner, there's not a lot of gain to be taken out of these yet. There's not a lot of gain to go. In other words, these things are so extended and so deviated from means, you're going to get a rotation, and that rotation, ironically, would be into the most oversold sectors, which are mega cap growth and buyback achievers,
Yeah.
because those are the ones that have been under the most pressure.
Okay. So
Right.
we could return to our regular programming, is what you're saying.
Yeah. So again, look, I have no idea if that's going to indeed be the case. But again, knowing how sector rotations work, and again, so a good example of this, you and I were talking last October, and we said, hey, we're buying some healthcare stocks because they're really beaten up. Nobody likes healthcare right now, and tech is really overbought. So we reduced our tech and bought healthcare. They did great through the end of the year. Earlier and very early in this year, I told you that we were shifting a little bit out of growth and buying value in staples, and staples have done fantastic over the last couple of weeks. So these rotations happen all the time in the market, and this is why it's
Right.
important to pay attention to them. because it'll help you identify risk sooner than later so that you can make so you can take advantage of what's out of favor and start buying stuff that's in favor. And a good example of this, financials have been under a lot of pressure over the last, couple of weeks in particular. Let me light these up. There we go. Transportation has been running with that small cap trade, very overbought. Energy's been doing great. Part of that small cap trade, very overbought. Materials, same way. This is that economic reflation story at work. These are extremely deviated from their long-term means. And again, financials now, utilities, real estate, technology are more of the oversold camp. So again, this is where I'd be looking at maybe buying some financials, maybe buy some, kind of value growth, uh, and kind of look at maybe taking some profits out of my kind
Wait,
of
wait, wait. What's
economic growth
value
cycle.
growth?
Sorry?
What's value growth?
No, value and growth.
Oh, value and growth. Okay.
Not well. And look, here's a kind of an interesting stat for you, right? Nvidia is a value stock. It's if you take a look at Nvidia, right?
If you look at it on a price to growth basis, is that what you're talking about?
Yeah, it trades at a 0.49 price to growth. Even
Yeah.
their forward PE is 24, right? This is not an overvalued stock by any stretch of the imagination, not given the rate of growth of their earnings, right? So, I mean, that's what I'm saying. So there is an argument to be made for a quote unquote value growth stock. Those do exist, but and specifically what I'm talking about is building a portfolio that has some growth components to it because if markets do well, they'll do well, but also add some value for protection.
Okay. Hey, and folks, he just hopped off it, but the charts that Lance was going through earlier were from RAA's Simple Visor service.
Right.
Fantastic service as we've talked about in the past, but during the conference last weekend, one of the members of Lance's team actually kind of did a real deep dive and walking through a lot of the powerful tools that are in there. It is such a phenomenal tool that you guys have built
Yeah.
there, Lance.
Oh wait, I'm
Um,
so excited too because we're very close to launching the new version, which is got AI integrated into it, and it's really really cool. So I'm really excited about that.
all right, and I'm still not entirely sure what that means, but when it launches, we'll let you walk everybody through it
There you
here.
go, no problem. Yeah,
Okay.
it just basically says that it's smarter than I am. So,
Well,
by the
I
way,
mean,
which doesn't take a lot.
I was gonna say, how high is that bar, brother?
That
Yeah,
bar is
exactly.
pretty low, Adam. Pretty low.
All right, look, still some more topics I want to bang through. We're going to have to
Wait,
start to get to kind of lightning round here. Um, so you made a case that if things get rocky in the markets, uh, because everything has gone up pretty much, capital is going to rotate into assets that are unloved right now, like treasuries. But in the interim, given all of the drama that's been going on, particularly with tariffs in Greenland and
yep.
Trump going over to Davos and kind of reading the riot act to all the Europeans on their home turf. Um, we've seen bond yields rising, especially as Europe has, puffed up its chest and people have said, "Well, we're going to stop buying your treasuries, America," and that's already happened with a
So glad
few.
you brought that story up.
Yeah. So anyway,
That's a hysterical story, by the way. We'll talk about it.
okay. I just want to give you a chance to speak to the rising bond yields.
Well, they haven't risen. You had that they
Well,
moved.
I mean, come on, they have a little bit. They were close
Oh,
to four, and now we're 4.2 or whatever.
yeah, you're at 4 point.
4.2
Let's see.
plus.
Today you're running yields at. Wait, hold on a second. I just looked at this a second ago. Your yield's 4.25. I mean, you've been hovering around, 4.1 to 4.3. This isn't, yields have been stuck here for a while, but again, there was kind of a knee-jerk reaction to the announcement that this Denmark pension fund was going to sell their treasuries in response to this whole issue over Greenland, which was laughable because they own $100 million worth of treasuries. Just as comparison,
Which is what, like 10 minutes worth of buying or something?
well, just a comparison, my firm, we own near 300 million in treasuries because we have 2 billion under management.
Right,
So,
right, right. And
and
you're a
so
60/40 firm, so you've got
yeah,
to.
yeah, yeah. So, we have almost 300 million in treasuries. So, but even with that, I'm going to make a statement tomorrow morning. We're going to sell, we're not, okay. Just if you're a client watching this, we're not going to do this. But I can make the statement tomorrow morning, we're going to sell all of our treasuries in response to this action. It would not even move the market. There's a pension fund sitting there going, yeah, I'll take all that you
Yeah,
got, give it to me now.
yeah.
I'll
Have
take
any
it.
more?
Yeah. The latest bond auctions went off with a dramatic increase in foreign demand. Foreign demand of owned treasuries now are at an all-time record. But importantly, Europe saying, yeah, Europe's great because I always say this stuff that's complete nonsense. First of all, most of the treasury bonds in Europe are owned by individuals, institutions, those type of things. They're not owned by the central banks. And so trying to get a coordinated effort of that would be near impossible to get them to dump their treasuries. But secondly, it's nuclear death for them
Right.
because again, their whole trade system is based on the US dollar. And so if you go dump all your treasuries, you have to eliminate all your reserve currency. You've now completely screwed yourself. So these narratives are hysterical. They make great for headlines. And everybody kind of reacts to them, but again, just the reality of it is so laughable that it was funny that anybody even paid attention to it.
Yeah. Well, and it also just begs the question, okay, you don't want America's debt, all right? Whose debt are you going to
Yeah,
hold,
where
right?
are you going to put your reserve currency now? Yes.
Yeah. And look, I'm not saying that to sound like um, a braggadocious American, but it really is. At some point, it's just like, look, the next alternative has a lot of issues along with it.
Oh, I did an interview. It's going to air on Monday with a guy named Parker White. He's the chief officer for DeFi development. You heard Daniel Kang over the weekend at the summit. This is his partner. But we just did a deep dive into stable value coins or
Hmm.
stable coins
Stablecoins.
and the impact that is going to have because all of those stable coins are basically going to be using treasuries to peg to the dollar, which is another, and as those stable coins gain traction for immediacy of payments, et cetera, that's just increasing the rate of demand for US treasuries, which is going to require all these other countries to own even more treasuries to maintain these stable coin transactions. So this is going to be stable coins. And again, the more I got in that conversation with him, it really was fascinating because I knew that was going to be important. I had no idea how big that's going to potentially be.
So folks should definitely go listen to Lance's interview there. But Lance, I think we talked after I'd interviewed Brent Johnson back in November about this, and it was so mind expanding when you
Yeah.
really start peeling the onion there, and it really all this concern about de-dollarization in the world. It's hard once you understand stable coins not to see re-dollarization
Mhm.
as an inevitability here. So, anyways, folks, watch that interview with Lance, and then if you haven't watched the one I did with Brent, highly recommend you go watch that one as well.
And by the way, if you ever want somebody to talk more about it, I'll hook you up with Parker. He's really, really well spoken, very, very knowledgeable on the whole crypto space, how it works. So yeah, it was a good interview though.
Well, thanks, and
I
I'll
learned a
definitely
lot.
I'll
So
definitely watch it. Okay, so bond yields, you're kind of like, nah, not a big deal, at least not at this point. Okay, so a couple other quick things. Want to get your quick thoughts on what's going on with oil and gas. They're having quite a strong start to the year.
mhm.
Natural gas has had a week for the ages.
Yeah.
I think it's up like 30+% on the week, which is huge for a commodity. Um, just a quick promo here too. So this video is coming out on Saturday, Lance, the day after Sunday. I'll be releasing an interview I just recorded with Rick Rule. That's a deep dive in the oil and gas industry. And I'll just say, folks, that Rick, I asked him, on a scale of 1 to 10, given your long career, Rick, and your many different successes with identifying, getting in early on a big trend,
Mhm.
how are you looking at the oil and gas opportunity right now, given their current valuations and given where you think the value of the sector could go? And Rick's answer was a 1. And for a minute, I thought, really? I thought you were excited about this. And he said, oh, I thought 1 was the best.
Oh.
Um, so he goes into a lot of
Depends on your
details.
scale.
Yeah, exactly. So he goes in a lot of detail with that. But when a guy like him, who has made so much money from basically riding repricings of major commodities, says, I think this is one of the best opportunities I've seen in my career, we really should pay attention.
Yeah.
So, anyways, you and I have talked a bit over the recent months about how this is looking like an attractive time to start building positions in oil and gas. And I know that you guys have some core positions anyways at RIA. But we've talked about maybe you guys might start increasing your positions and whatnot. What do you think? How are you feeling about what you're seeing so far in the performance of oil and gas so far this year?
Great. I mean, we just launched recently an entire energy-centric portfolio that's already up 6% for the year. And we literally just launched this thing like 4 weeks ago. So it's doing really, really well, outperforming the market. But again, yeah, I still think there's risk to the oil market this year. If the economy slows down, if
Sure.
there's a lot of ifs, right? But I think you're going to see little spurts in oil, right? I mean, things are going to happen. Like natural gas went up 30% in a week because we're all going to die of frostbite over the weekend.
Yeah. But
Um,
by the way, my little brother lives in Wisconsin. He just texted me. It is the weather thing said it's like -15, but feels like -38. I mean,
yeah,
that is god awful cold.
yeah, and it's going to be we're going to be you know freezing here over the weekend in Houston. It's supposed to be in the 20s this weekend. I know for a lot of people, it's like, in South Dakota, they're going to be in the 20s. They
Yeah, I
have beach
know.
weather, but for Houstonites, that's pretty damn cold here. So, but, so yeah, not surprising natural gas spike. You're going to have that kind of stuff with oil going on as well. Oil has a lot of seasonality to it. Hurricane season is a good example as we get further into summer. But so I think oil, my base case outlook is that oil is going to struggle a little bit, maybe this year, unless something happens. But if we get something like peace in the Middle East, and all of a sudden we get a lot of reserves released into the market, that's going to suppress oil prices. So I think you need to watch.
Right. Or peace in Ukraine too.
Right, yeah. I think you need to watch those type of events, but I do think longer term, and again, we've got some core positions as we discussed at the conference on that kind of the behind the meter play on the power gen side of oil and gas. But I do think there's a place as we get through this year for companies like an ExxonMobil or a Diamondback Drilling or a Schlumberger, those type of things, which those companies will do well and probably continue to do well. Plus, you get a
Okay.
nice dividend from these companies as well.
Well, so that's exactly it. So Rick, I think, wouldn't disagree with you, Lance, where he thinks it could take a year or two, maybe even 3 years for this sort of repricing that he expects to
Mhm.
happen to occur. And I'll say I'm actually hoping that oil goes down this year because I'm kind of on a dollar cost averaging program
Right.
right now. And I would love to be buying over the next year at lower and lower prices here as I build my positions. But I asked Rick this, and he said, "Yeah, it's absolutely great." He said, I said, "Look, versus a number of the other things that you got in early on. So, like Rick was very big on uranium several years before it took off, right? And he was beating the table, saying, 'Look, folks, I don't know when this is going to go, but when it goes, it's going to go big.'" He was exactly right. But during those years where he was in and waiting, he's just eating the opportunity cost of the capital he has invested in there. Where here in the oil and gas space, you actually
Mhm.
get pretty attractive dividends. So,
Yep.
he's basically saying like there kind of almost is no opportunity cost to capital. And so, that's getting subsidized by the dividends. And then, if the
Mhm.
thesis is correct and the price then pops, like, it works doubly well for you. So,
Yeah, absolutely. No, and look, we're big advocates. We run two different types of dividend models. We run a pure dividend model, and we have a dividend growth model, which combines growth stocks with dividend stocks. But when we're even in our standard core portfolios, we have positions that yield dividends because again, when you think about investing, you should always factor your portfolio on kind of a three-legged stool. And the biggest mistake that investors make is they start focusing on one aspect of their portfolios, like I'm all in growth stocks, which is fine, but now you're solely tied to capital appreciation. Your stool, your portfolio should have three legs to it. Dividend income from stocks that you own. So
mhm.
that's an income stream that you're going to get. Interest income from bonds, because bonds protect your capital and provide an interest payment into your portfolio. So you're constantly getting cash flow coming in, which can then be reinvested into other stuff. And then have your capital appreciation component. So all three of those give you a nice total return structure for your portfolio that will not only lower volatility of the portfolio, but in periods of sideways markets or down markets, you're still accumulating cash because of all of that income that's coming in. So it's always helping the portfolio grow, stabilize, maintain itself, and gives you cash flow to reinvest. It's always fascinating to me. It's like people go, well, you should just buy and hold the markets and then dollar cost average on the way down. Sounds great. Except if I'm buying and holding, that means I'm fully invested into these ETFs. And so when the market's declining, I've got no money to invest, right? I never
Right.
get profits. Well, what dividend and income gives you is the ability to reinvest capital all the time back into your portfolio. So,
Yeah.
so yeah, we're really big advocates on dividend. It's such an important function of the portfolio over time.
Yeah, and I got to say on that, as I have built my wealth over time, like most early investors, I had a very equity capital appreciation mindset.
Mhm.
And once I started working with a financial, and I would write things up and write things down. Um, Once I started working with a professional financial advisor, and I sat down with them and they really tried to understand what kind of investor I was, and they were like, "Whoa, yeah, all right, you're actually a pretty conservative guy." Um, so, let's make sure that we have a good income, sort of conservative income part of your portfolio.
Mhm.
I got to say, as the years have gone on, God, do I love just logging into my account and just seeing it go up because the income checks just keep coming in. And of course,
Yeah.
as your wealth builds over time, those income streams get bigger and bigger, right?
Yeah.
And you
Yeah.
don't have the huge varieties that you had before. It's just for a guy like me, it's great just to see a steady Eddie improvement. Yeah.
No, absolutely. And look, I love the stock market. And I'm like you, when I was younger, I was all about the stock market, right? So all my money was invested in stocks and blah, blah, blah. And now that I'm older, I've shifted a big chunk of my money to assets that generate me 10 to 12% a year, every single year, and just create that with no volatility risk, right? So I've got, I do a lot of
Lance,
private
you're gonna
those
get
type of
so
things.
many emails after this of people saying, "Wait a minute, where can I get this no
Yeah, yeah.
volatility 10 to 12% return?" Yeah.
Well, again, but I do hard money lending and I know how to do it. So, I have other firms that I work with that also do hard money lending. But I mean, it's a complex process, but I've built this ability to create these 10 to 12% rates of return. And so if the market goes up 20, great, I don't care, right? If the markets go down 20, great, I don't care. I get checks every single month. And it changed my outlook about investing in markets over time because once you can become okay with just having cash flow, all of a sudden the risk profile that you need to take to generate wealth drops dramatically. And
Hmm.
once you can get yourself away from chasing markets to build well, again, one of the worst things that we ever did to individuals, particularly younger kids these days, is televise everything, right? It's like, the market's up today, this is happening. And so we benchmarked everybody against this index that goes up and down every day and just turn the markets into a casino. And that kind of erodes the real ability and the real fact about investing capital, which is to make it grow steadily over time. And so once you can get to that mindset that if I can create enough inflow that I don't have to worry about anything else, life becomes really easy after that.
All right. Well, look, folks, especially if you are older, income becomes a really important part of your life too. If all this stuff sounds attractive to you and you don't feel like your portfolio is set up optimally the way you'd like, and you want to talk more about the potential of things like income or making sure at least the three stools of your portfolio are working together in unison, go talk to your financial advisor or go talk to Lance and his team. And of course, I'll tell you how to do that in just a second. All right, Lance, I'm going to punt the rant for today just because we're getting long
But just
here.
tell me the topic so I can be prepared for next week.
It's one you're gonna like. There's a fitness element to it. Don't worry, you're gonna react to it just fine.
Okay.
Um, but real
Keep me in
quick,
suspense.
we're gonna get to your trades real quick. But
Huh?
before we do, I just want to put up the bad idea of the week. All right, and I'm just gonna read this headline to you. You may soon be able to use a buy now, pay later plan for your rent.
Jesus.
Yeah.
This, this right here is why the youth is basically destined to fail.
Mhm.
This is terrible advice.
Oh, it's the worst advice. It really is just the worst advice. It's going to create a whole, generation of lifetime debt slaves, debt serfs.
Yep.
Again, you and I have said this is the most obvious future headline we're going to see, which is, catastrophic losses in the buy now, pay later space. Whoever could have seen this coming? And we're just
Right.
going to be raising our hands saying, us and probably
Yeah,
almost
yeah,
everybody else with two neurons. Yeah.
exactly. Yeah, I
But
know
you talk, you talk, you
it's
talk about
always
how creative, consumers are when times get tough, that they can still find money to keep their spending going. They can, and part of that is you know, a positive attribute of the creativity of human beings, but a huge part of that as well is whatever you want to say, a massive uh, condemnation of the evils of the industry that will sell these people the rope to hang themselves with.
exactly. No, it is. And unfortunately, it's just, again, this goes back to our whole conversation at the beginning of the show, talking about financial education. you know, we shouldn't even be offering this stuff out to people. This shouldn't even be an option. And, but we did this with subprime mortgages. We did, we've done it. Why do we have a housing problem? Because you did subprime mortgages. You can trace it all back to, zero interest rates, subprime mortgages, all this type of stuff that we did to let people buy stuff that they shouldn't be buying. And, we keep doing it. And then we wonder, and again, to your point, then when it all blows up, everybody goes, well, nobody could have seen that coming.
Right.
It's not hard to see it coming, right?
Right.
But
And then, by the way, we need to bail them out. It's like, why? We
why?
all could see that this was going to be the end case.
Exactly.
And you know what's so interesting to me too, Lance, is like we the regulators stepped in front of the five-time leverage ETFs,
Finally.
right? And I think they should have. I applaud that, right? But all right, if you've got money to be investing and you feel like you're sophisticated enough to take the risk of a five-time ETF and it blows up on you, you know what? I mean, that was a risk that you largely took with your eyes wide open. Yes, there will be novice investors who get burned on that, right? And again, that's why I think they should have stepped in. But that's a class of people who's not necessarily in dire straits right now. The people who are turning to buy now, pay later to do things like DoorDash or pay their rent are people in dire straits right now. How come the regulators aren't lying in front of that? That you're going to help a lot more people who need it
Correct.
more with that, right?
Yeah. I mean, this is why the whole what was the whole organization we put together, the financial
The Consumer
consumer
Finance
protection
Protection Bureau?
division.
Yeah.
Yeah. I mean, that's their job. They should be looking at that going, that is not good for consumers. Look, we shouldn't have to put guardrails on consumers. We shouldn't have to tell you what to buy or not to buy or how to save, but apparently we do. So maybe
I'll bet
we
you if we
need a
looked at the
consumer
Congress people
protection
who were
division
involved in creating that, they're getting big checks from companies like Affirm.
exactly,
Yeah.
exactly. So
All
anyway,
right. Well, look, that
another
wasn't
rant
the
for another
rant,
day.
but I knew that would trigger you a little bit.
Yeah, next week we'll get into that.
Okay. All right. So trades. What trades have
Uh,
you guys made over the past week?
the only trades we did were just basically yesterday. We just took our positions in silver and gold back to target weights. We've done this like 3 times
I
this year.
know. Yeah.
They get like extremely overweight in the portfolio. We trim them back to target. And we've been kind of watching Bitcoin here lately, and just on a weekly basis, Bitcoin's getting extremely oversold, getting to start to see a little bit of a technical recovery, and we're not on a buy signal yet, but starting to approach that on a weekly basis. And historically, when we've seen these types of signals occur, it's been a pretty decent little run, probably 20-25%. So
Mhm.
we just started taking, as we were saying earlier, right? If you take profits in silver, what are you going to do with it? Just let it sit in cash? No, we're looking for opportunities elsewhere that haven't come yet. And I think at some point people are going to go, you know what? Bitcoin's really kind of been beaten up here lately. I think there's going to be some opportunity there, and
Mhm.
at least you get some buying interest here for the near term, just a rotational basis. So that's what we did this week.
All right. So let's try to talk a little bit about that next week.
Sure.
It sounds like you haven't bought yet. You're just watching
No,
closely
no,
at this
we
point,
did.
right?
We bought a so our portfolio weight in Bitcoin could go up to 5%. So we're at 2% right now.
You're at 2%. What were you at before you bought in?
Zero.
Zero. Okay. All
Yeah.
right. So you've made an entry position in it. When we talk next week, I also want to ask you about MicroStrategy, because I was actually talking to my wife this morning. We were
Mhm.
looking at the portfolio, and I said, look, the one thing that's really not doing well is MicroStrategy, which is down over 50% from where we bought it.
Right.
I actually didn't buy much at all. It was a little just sort of toe in there because I don't have much Bitcoin exposure, and I'm thinking about maybe
Right.
taking some profits from silver and putting it into that for exactly the reasons you're talking about. But we'll get into that
We
more
will, and
next
I'll
week.
tell you why not to do MicroStrategy, but we'll talk about that next week.
Well, and that's why I want to talk with MicroStrategy, because there is a leverage going
Mhm.
on there, and one may argue, well, hey, when Bitcoin goes back into their upcycle, MicroStrategy might go to the moon. So I want to hear your thoughts on whether that may or may not happen.
Sure.
Okay, all right, folks. Well, look, if you think that the fastest way that you could send your personal prosperity to the moon is to continue to watch Lance Roberts on this channel week in and week out, please let him know that by hitting the like button and then clicking on the subscribe button, as well as that little bell icon right next to it. Just a reminder, if you would like to get some help from a personal financial advisor for all the reasons that we've already talked about here, if you don't already have a good one advising you, consider talking to one of the ones that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. Perhaps you'd like to talk to Lance himself and his team there at RIA. To do that, just fill out the very short form at thoughtfulmoney.com, and the advisors will be in touch with you very quickly after you do that. Folks, I'm going to give you a couple of other links here too. So Lance just had his conference. The Thoughtful Money Spring Conference is now fully planned out. It's going to be Saturday, March 21st. I haven't kicked off the marketing for that yet, but that's going to start happening really quickly. So for those of you that are signed up for our newsletter on our Substack, keep your eyes out for that. I will just mention though, the faculty gets better every year. This year it's amazing. I'll give you the full list in a little bit when we kick off the marketing, but it'll be kicked off by Lacey Hunt, as always. We've got Matt Taibbi joining us this year. We've got Ed Dowd joining us this year for the first time. We're going to have Rick Rule come on and really open his kimono on not just all the oil and gas stocks that he likes, but a number of other commodities as well. There's a whole bunch of other folks as well, but I'll keep you in suspense for those until we do the official announcement. But if you want to lock in your ticket at last year's prices, I'm not sure yet whether we're going to be able to keep them flat or whether we're going to have to raise them a little bit for the spring. But if you want to buy them now at what the price was last year, you can go to thoughtfulmoney.com/2026, and you can buy your ticket for the spring conference there at a 0% inflation rate. Last thing is, silver, who knows what's going to happen? And I just talked about how if you've got a lot of it and you're sitting on big gains, you should protect them. But if you haven't been in and you want to either create your initial exposure, or if you think silver's still got a fair amount of road to run here, we just want to remind folks that the promotion that Andy Schechtman of Miles Franklin, Thoughtful Money's precious metals solution, indoor solution, he still has supplies that he is making available to this audience to buy junk silver at just 99 cents above spot price. And Andy has said this is one of the lowest premiums he's ever seen in his career. So if you want to take advantage of that, or just talk to Andy and his firm about any other precious metals needs you may have for buying, storing, or selling, just go to thoughtfulmoney.com/buygold and fill out the short form there, and Andy and his team will be in touch with you right away. Speaking of buy gold, Lance, gold is now, what's that? Just $15.17 away from the big round number of $5,000 gold. So maybe we'll talk about that next week too.
Yeah, no, we'll get there. I mean, markets love round numbers. So 5,000 gold, 7,000 S&P. Yeah, markets love it.
Markets love it. All right. Well, thank you, my friend. Another great week. Again, really wonderful to see you in person, and
Absolutely.
congrats on a great event.
Thank you so much. I'll see you soon.
All right. Everybody else, thanks so much for watching.
If bonds are getting inflated, if real estate is getting inflated, in the CPI, they decided that you don't actually own your home, you rent from yourself. So it's a rental equivalent of what it's insane is what the CPI is. But this sort of corroborates what I was saying, that the truth lies somewhere in the middle. $12,000, that is actually a reasonable target if gold goes into the same type of bubble that it was in back in 1980. The M2 is probably, and it ended up right in the middle. And so, yeah. So $1,000 silver is possible. I doubt it, but triple digits, I think that's a slam dunk, like I've said many times. And so Silver is incredibly undervalued right now.
Recent analysis suggests that gold could reach $12,000 per ounce, mirroring the speculative surge seen in 1980. However, such a scenario requires a significant global crisis or a major shift in monetary policy. Currently, gold is trading at approximately $3,500 per ounce, indicating a substantial gap to this projected high. As for silver, while reaching $1,000 per ounce appears highly improbable, the metal is considered undervalued. Factors such as increasing industrial demand, particularly in electronics and renewable energy sectors, along with a widening gold-to-silver ratio, suggest potential for price appreciation. Mike Maloney, a well-known precious metals expert, author, and economic educator, highlights that gold has historically preserved purchasing power, but it also experiences bubbles, something it's not in yet. Compared to past decades, gold now buys far more stocks and real estate. Both gold and silver remain undervalued, with silver especially lagging behind even inflation-adjusted levels. Gold's popularity has rebounded to 23%, still below its 2011 peak of 34% after the 2008 crisis. Unlike 2011, today's volatility stems from policy and market factors rather than systemic threats. The World Gold Council reports that central banks purchased a record 1,037 tons of gold in 2024, continuing a multi-year trend of official sector buying. Silver prices in 2025 are expected to follow a steady upward trend, with a notable acceleration in the fourth quarter, during which December could see highs of $42.44. This growth may be driven by increased industrial demand amid global energy transitions and supply chain constraints. Investors are likely to view silver as a strategic hedge, particularly in light of ongoing geopolitical uncertainty and persistent inflationary pressures. Both gold and silver are experiencing notable market dynamics, influenced by macroeconomic factors and investor sentiment. Before we examine the video, please click the bell symbol and subscribe to receive updates on our latest uploads. We always value your thoughts and feedback.
Well, yeah, he's the great hedge to maintain purchasing power is true over the centuries, but there are times when it goes into bubbles, and it's not in a bubble yet. If you want to increase, if it were true that it has only kept up with inflation, then right now, the Dow Gold is at like 12 to 1, and it was 45 in 1999, 2000. I believe it was like 38 when I first started investing. So I can buy like 3 times more stocks with my gold. I can buy a whole lot more real estate with my gold and silver than I could back then. So it's gaining in purchasing power if you're buying it at the right time, because it goes through these overvaluations and undervaluations. And when you measure it against, decades of history, what you see is that we are still in a severely undervalued state right now. So it's gold and silver. Gold, if you use the CP lie, yes, it's corrected against inflation. Exactly. That's what causes a peak, is everybody trying to rush into it at the same time. And what we are actually seeing in the retail sector is low sales volumes right now. The public is still like yawning when it comes to gold and silver, and they're chasing the stock market right now, which is the Buffett indicator is just in insane valuations. When this next crisis happens, it's going to be one of the worst that has ever happened, because there's so many things are just so skewed. But what's interesting here is you have the shadow stats CPI, also called the shadow stats alternate CPI. Now, a lot of people think, oh, well, that's just some nut putting together. No, John Williams was an insurance actuary. And in the mid-'80s, all of his models stopped working, and he was wondering why, and he started researching it. And then he found that the government was changing the way that they calculate inflation. They kept on messing with the CPI. And he went back and used what he uses for this alternate CPI is the government numbers from World War II to 1982, the method that the US government used to calculate inflation. So these are both sets of government numbers. One of them keeps on getting massaged periodically anytime the CPI is coming in too hot and it makes the administration look bad. It seems to get adjusted. So what have you got there? I've always said also that the truth probably lies somewhere in the middle. But these are two sets of government CPI numbers. And one of them is adjusted to sort of cheat Social Security recipients out of their full, they don't keep up with the true cost of living. And all you have to do is, if you look at the CPI and look at your personal purchasing power, where it has gone, and prices, go to a restaurant. I've been traveling. You order a hamburger and a beer in a airport. Oh my God, it's just unbelievable. So,
yeah,
gold and silver have not kept up with true inflation, the inflation that you experience day to day. So I believe that the truth lies between those numbers. But gold is nowhere near being in a bubble. And so it shows that it should be, if the green government CP lie was true, then gold would be in a bubble, which would mean it would be of a large percentage of global financial assets, that it would be on the news everywhere, that every financial planner would be recommending put 30% into, what's interesting, nobody recommended gold back in the 70s until the last, all the financial planners switched to recommending gold. Put 10, 20, 30, 40% into your portfolio after the peak in 1980. And there's a movie called Brewster's Millions with John Candy and Richard Pryor. And Richard Pryor is going to inherit a whole bunch of, it's like $33 million or something like that.
Gold and the US dollar typically exhibit an inverse relationship. When the dollar strengthens, gold prices often decline, and vice versa. This dynamic is primarily due to gold being priced in dollars. A stronger dollar makes gold more expensive for holders of other currencies, reducing demand and thereby lowering its price. However, recent market conditions have highlighted a more complex interplay between these two assets. As of August 14, 2025, gold prices extended their rise for a third consecutive session, bolstered by increasing expectations of a U.S. Federal Reserve interest rate cut and a weaker dollar. Spot gold edged up to $3,357.65 per ounce, while the dollar remained near multi-week lows, aiding gold's appeal. Ongoing conflicts, such as the Russia-Ukraine war, have driven investors to seek safe haven assets like gold, even when the dollar is strong. Global central banks, particularly in Asia, have been increasing their gold reserves to diversify away from dollar-denominated assets, providing steady support for gold prices despite the US dollar's strength. Persistent inflation has kept gold attractive as a hedge, even in a strong dollar environment. The dollar's decline boosts gold's purchasing power. Mike believes silver reaching $100 to $200 is inevitable. Historically, silver has experienced significant price surges during periods of high demand and limited supply. While reaching $200 per ounce would represent a substantial increase from current levels, silver has surged in 2025, reaching multi-year highs, driven by strong demand and safe haven buying amid global economic and geopolitical tensions. Major financial institutions, including HSBC, Citigroup, and Bank of America, have raised their price forecasts, citing tightening supply and robust demand. When gold hits around $5,000 an ounce, investors may shift to silver just as they did in 1979. Despite these gains, experts like Michael Oliver consider silver undervalued and see potential for significant upside. Market dynamics, including industrial demand and limited supply, support continued growth. However, investors should remain mindful of potential volatility. Now, let's memorize the interview.
pretty nicely, sort of where it feels like it should be, which is, below halfway, but certainly not at the bottom of the valuation channel.
Right. And what's interesting here is that it's actually closer to the shadow stats line than it would have been to the CPI line. And M2 is basically where all of the dollars, this is the dollars that get created by the banks and the Federal Reserve, and they go out into the economy. So this is covering true inflation. This is also covering the inflation of the stock market. If bonds are getting inflated, if real estate is getting inflated, in the CPI, they decided that you don't actually own your home, you rent from yourself. So it's a rental equivalent. It's insane is what the CPI is. But this sort of corroborates what I was saying, that the truth lies somewhere in the middle. $12,000, that is actually a reasonable target if gold goes into the same type of bubble that it was in back in 1980. We don't have lines at coin shops. We don't have it in every newspaper's headline. It's not on the news every hour. It isn't dominating, and it will. There will come a day where it dominates the news cycle. Adjusting it compared to all these other financial assets, and it's what percentage change did real estate, the stock market, the 10-year treasury, GDP, currency in circulation, M2 currency supply, what percentage change did they have from 1980 until today? Now, the numbers are somewhat different than what you just saw in those graphs because we used the intraday high of $52.50 instead of $50. So, So this corroborates that M2 scenario of inflation. And we've got the dollar is collapsing. If you take $100,000 worth of gold and it goes to $10 million, yes, the dollar is collapsing. But you can buy 10 times more cars with your gold that is pricing those collapsing dollars. It is the canary in the coal mine. And what happens during an event like when the dollars are losing value, and they have been, I can buy so much more real estate, stocks, just about everything. I can buy more of today because I've been invested in gold and silver for so long. And other than cryptos, best performing asset of this century. And when you include cryptos, best performing, Bitcoin is up again. I don't know. Maybe it's not, but as of like a week or two ago, a best performing asset of this year, including cryptos. Mm-hmm. And so, yes, it is the dollar collapsing. That's part of the skyrocketing price. And that's the reason you've got to stop measuring stuff in terms of dollars. So I think the low range of where silver should go is that CPI number. That is like if we don't end up, I think triple digits is even inevitable without monetary demand. Getting to 100, 200, that still would not. Yeah, compared to those other financial assets, that 200 wouldn't be in a bubble. The CPI, the current one, the low CPI, is just that. It's a lie. And so I would look at $200 as probably the floor of a predicted future price. When? That's the problem. I don't know. I know that, if you look at my first book, I made like 10 different claims in them. 7 of them came true. The other 3 have yet to come true, but they will. It's just taking a lot longer than I thought. 2015, so the price of silver is more than double what it was then. But still, that gives you an idea. And that 1980 rush, that's what a bubble looks like. That's when silver was in a bubble. It's nowhere near that today, but that day is coming. And I do feel that it'll be somewhere around $5,000 an ounce gold, where people will look at it and go, wow, this was $250 an ounce in the year 2000. I think, maybe the silver is a better bargain.
Mm-hmm.
They'll think there will come a day where they think gold is too expensive. That happened in 1979. Gold had gone from $35 to $400. And people changed their preference in late 79 from gold to silver once gold was perceived as being a little bit on the expensive side.
Investor sentiment, geopolitical conflicts, and macroeconomic factors influence the complex environment in which gold and silver are navigating. Silver remains relatively inexpensive and has considerable room for growth, while gold maintains its purchasing power and continues to enjoy robust demand from institutions. Supply shortages, industrial demand, and safe haven purchasing all support both metals, indicating that prudent allocation now could yield significant returns in the years to come. Investors will continue to need to keep a close eye on market variables, such as inflation, dollar swings, and international crises. How will central bank purchases and continued geopolitical tensions affect the price of gold and silver in the upcoming year? How can the price trajectory of silver change if investor preference shifts from gold to silver? Please feel free to express your opinions in the comments section below. If you found this helpful content, please remember to subscribe to remain updated and to give it a thumbs up. Thank you for joining us on this journey.
So you're seeing retail catching the wave, which is driven by governments buying gold, right? So they have to get out of the way of the price. The price is running. Now silver's running. So that is what's going on. The question is, where's it going? And when I look, when is the situation with America, which is effectively saying it's on the warpath?
Right.
China's saying, we're just growing, we get bigger and more powerful. We've got 4 times more people than you, and give us 10 years, we'll have as much money. So we'll have 4 times as much money as you. We're the superpower now. And America's going, hold on a minute. No, we're in charge here. And stop that. Stop that getting richer at our expense. No, we see you now. We know what you're doing. You're going to stop that.
Retail investors are now riding the momentum in silver, fueled by governments accumulating gold and pushing prices higher. With the market moving fast, the real question is where it's headed next. On the global stage, the US is signaling aggression as it seeks to maintain dominance, while China, with its massive population and rapid economic growth, is positioning itself to rival America within the next decade. The US sees this rise as a threat and is determined to halt China's advance, setting the stage for escalating tensions that are further driving demand for precious metals. Clem Chambers is a well-known financial commentator, author, and entrepreneur. He highlights that gold is surging because governments view it as the currency of war, a hard asset essential for defense and global power, beyond the reach of paper money or manipulation. With the US and China in open rivalry, central banks, especially China's, are buying heavily, driving prices higher. Silver, on the other hand, has always been everyday money. So as gold becomes too expensive, retail investors are piling into silver as the affordable alternative. Together, this creates a chain reaction where governments fuel gold, retail fuels silver, and institutions can't stop the momentum. For additional information, view the video. Please subscribe and like the material if you enjoy it, to receive the latest updates.
Well, hold on a minute. Gold's a bit expensive now. What? $3,500 an ounce, that tiny little fleck of and silver, I can buy a sack of it. I can buy a load of old quarters from 1935. And by the way, if the world did end, I can go to my neighbor and say, see that chicken? I've got a silver quarter for you. I'll buy it. You can't do it with gold coin, can you? So anyway, the old currencies apply, but silver, gold back in the day was not money, it was currency. You have a few gold coins, you put them under the floorboards. It's not everyday money. You don't walk around with it. Now, if you think about gold, silver, copper, gold is for your cash, your wealth. yeah, or whatever counted for banking, actually put it in a bank, literally bury it underground in the corner of your house. That's how they used to do it. Silver, now that is purse money, that's wallet money. You carry that in a little sack which you tie to your pants. Okay.
Right.
So you don't really lose it because it's in a purse. You might bury the purse if you're having a problem. It might split. It might all fall out. That would be a pain. But but you put the copper in your pocket. That is pocket money. So you've got pot money, purse money, and you've got pocket money, right? Which is why if you go treasure hunting, you will find infinite quantities of copper because it was in the pocket and easily lost.
Right.
Yeah. So that is the hierarchy of metals. Yeah. So gold is for cashing. Silver is for high-ish value transactions. Yeah. So that's why it's retail. That's another reason it's retail. So anyway, a retail looks in and goes, look at that gold go. Oh, I'll buy silver. And that's what you're seeing now.
Right.
So you're seeing retail catching the wave. Yeah. Which is driven by governments buying gold. In the old days, your investment banks will go, hey, gold's going on a run. We're short that. We're short that. We're short that. Oh, yeah. We manipulate the price. And retail will go, oh, no, I'm losing money. I'll sell. Oh, I'll take it
Right.
back. I'll take it back. And you
Right.
can,
Right.
and the institutions can do that with retail because retail is, there's always the frothy part of retail that is easily manipulated, but they
Right.
can't do that to government. That's, that's playing, that's wrestling Godzilla. You are going to lose. Right. So they have to get out of the way of the price. The price is running. Now silver's running. Yeah. So that is what's going on. The question is, where's it going? And when I look, well, I mean, when is the situation with America, which is effectively saying it's on the warpath?
Right.
Yeah. I mean, China's saying, yeah, we're just growing, we get bigger and more powerful. We've got 4 times more people than you, and give us 10 years, we'll have as much money. So we'll have 4 times as much money as you. We're the superpower now. And America's going, hold on a minute. No, we're in charge here. And stop that. Stop that getting richer at our expense. No, we see you now. We know what you're doing. You're going to stop that. Well,
Clem Chambers demonstrates that China under Xi has shifted from cooperation to confrontation, reviving Maoist ideas, discouraging Western influence, and asserting power over Taiwan. This has fractured global supply chains, turning critical resources like rare earths and cobalt into weapons of leverage. The U.S. is responding by rearming and rebuilding industries like shipbuilding, which are essential for military strength. Strategic reserves of gold, silver, and critical materials are becoming vital as global trade routes grow more fragile and politicized. Clem emphasizes that this dynamic is reshaping geopolitics. America is pressuring Europe to rearm while also courting India to counterbalance China. Russia, though armed with nuclear weapons, lacks the economic weight to compete. China, however, is a true rival, with far more financial resources and technological capacity. The global stage is being redrawn into blocks, and for ordinary people and markets, the consequences mean heightened risks, disrupted trade, and the urgent need to secure assets in times of escalating conflict. Let's redirect our attention towards the interview.
Xi came in to China and brought back Maoism, which is not good. He said to his children, stop playing computer games, start getting fit, stop learning English. Hey, Taiwan, we're coming for you.
Right.
Well, that's what kind of started the ball rolling. Yeah. Now, their predecessors were much more, we'll be your friends. We'll make your plastic junk. We'll make money. We'll all be very civilized and nice. And, we can all be friends. But Xi has taken a China exceptionalist point of view in the same way as America takes an American exceptionalist point of view. And in fact, the world needs to be more like the Europeans who, up until recently, have been quite laid back. We can get on with you. Yeah, build a pipeline. Yeah, let's all do business. Yeah, let's all be friends. Well, that polarity means that all these global supply chains are now fractured. Yeah.
Right.
So you can't actually rely on your cobalt flow anymore or your rare earths anymore. And that's the base of your economic pyramid. And whereas before they were commodities and they just got loaded up to ships and sent to wherever they needed to be, and everybody was, relatively reasonable with each other. Now it's like, oh no, you can't have your rare earth. No. We've weaponized it. No. See how far you're going to get with your business without our rare earth. Oh, cobalt. No. So now countries basically have to build up strategic reserves of all sorts of critical things. And
Right.
silver's just as good. You start by going, oh, the only thing we need is gold because gold, that's bullets and that we can buy everything we want with gold. And then you go, actually, maybe we can't. Maybe we won't be able to buy it all. Maybe we won't, if they're shipping it and they say, no, if a ship goes there, we're going to sink it. I mean, what's been going on with the Houthis? They've been firing at ships. The thing that happened also that is, I had to check up to see whether it happened, and it actually happened. Trump came out and said, if you've got a Chinese ship and you land containers, we're going to bill you. We're going to bill you 2% of the value of those containers when you
Wow.
land. So if you're a container ship built in China, that's a $7 million bill just to pull up at the port.
Wow.
Yeah. And that's so that people buy American ships, not that America makes many ships just yet, so that the ship industry in America will take off again. And why do they want shipbuilding in America? Well, if you can't build ships, you can't build battleships, can you?
Mm.
Yeah, you can't build all those Liberty ships that were built in the Second World War to ferry all that important equipment around the world as you're fighting World War III. Oh,
Right.
oops, I can't build ships. Well, actually, maybe we'll build a few shipbuilding. Oh, I can't build ships because I haven't got any iron. Oh, still, no, and I haven't got any I've got no
Yeah.
rare earths. I can't build any planes. Yeah. So that is what's driving all of this. It's basically America rearming.
Wow.
And yeah, exactly. And it's not good. It's like, okay, you could say they have to, they need to, they must. Okay, I'm not going to argue with that. But what that actually means in reality to people like us and to the markets and to the world economy and what is the denouement on that? Normally, these things don't suddenly heal themselves and everyone's friends. That is dramatic, absolutely dramatic. And that drumbeat, I mean, when they had that speech in Europe, it was like, oh no. And then you go, well, I'm just being paranoid. I'm old and I'm paranoid. Oh no, they've done something else. And every dot on the map, it only makes sense when you see it as America rearming.
Right.
And they've told Europe to rearm, and Europe is rearming. Well, that's not good. I mean, okay, forget it. Maybe it's great. I mean, maybe I'll be, old enough. I won't care that there's World War III started. But maybe I'll make so much money. I'll be in Chile. I'm drinking red wine, crying, but I'll be far away. But nonetheless, it's not. I can't change that. The only thing I can do is look at it and see where there's real returns to be made to
Right.
secure myself and my family. And that's how I look at it. It's, I can't, maybe it's necessary to have World War III. It's nothing to do with me. I can't affect that in any shape or form. But there you are. There is that drumbeat. And they might stop. After all, somebody wants a Nobel Prize. Maybe China is too fragile to get into this Cold War conflict. Maybe it's, Russia versus America all over again. Maybe it
Right.
isn't, whatever. But if you don't realize what appears to be going on, you don't track it, and you don't. I mean, something that is. I was relieved a few weeks ago. Trump was getting angry at India, at Modi.
Yeah, I heard about that.
Yeah, but you realize the moment America starts sucking up to India, that is very, very bad, because in a global conflict, it's China, India, Russia, and America and Europe, right? India is a major player. Now they historically go, nothing to do with us. No, 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 no. Nothing to do with us. Nothing,
Right.
nothing to do with us. But if America is really accelerating, it has to make India either neutral or their friend. Because then it's China and Russia. Well, Russia's nothing. Everybody's worried about Russia. Russia's 150 million people with no money. Right? China is 1.n billion with all the tech that we love. I mean,
Wow.
forget Russia.
Yeah.
Russia is, not a thing really. I mean, it can nuke everybody. That's the thing it's got. But you take away its nuclear, what has it got? It's got no money. It's got hardly anybody. Yeah, 150 million people versus 500 million people, $7 million GDP versus a $35,000 GDP per head. It's like
Wow.
1/18th of the economic power of Europe,
Yeah, it's a
without
big
even
difference.
factoring America in there.
Yeah.
But China's a different matter. China's got more money, literally more cash in dollar terms, it has got twice as much cash in dollar terms in America.
Wow.
So if you counted up, if you stacked up all its yuan, and you said that's that much for dollars, and you stacked up all the American dollars in existence out there in circulation, it's got twice as much. Yeah, you fly into Shanghai at the airport, and you fly into JFK, and you think these JFK versus Shanghai Airport in a battle. There's only one winner there.
In short, the world is entering a new era where gold and silver are not just investments but lifelines in a fractured global order. As nations rearm and tensions rise, precious metals are gaining renewed importance both for governments seeking power and individuals seeking protection. The momentum in these markets reflects not just financial trends but deep geopolitical shifts that will shape the decade ahead. How long can central bank demand continue driving gold and silver higher before retail investors face a major correction? Could rising geopolitical tensions accelerate a shift toward a new monetary system backed by precious metals? We'd love to hear your thoughts, so share your comments below. Don't forget to subscribe for more content and hit the like button if you found this video valuable. Thanks for being part of this journey with us.
Same time U.S. declares silver as a national priority, you have Saudi Arabia buy a bunch in SLV. You see India's demand of silver is up 431% year over year in May, and record ETF inflows in June despite higher prices. So yeah, I mean, there's a lot of demand for physical metal that hasn't translated into the retail side of it yet. But the rest of the world, the big money, whether it be on the exchanges or the central banks or the sovereign wealth funds, are making it very clear that silver and gold are quite significant, and platinum, to their plans.
The U.S. has officially declared silver a national priority, signaling its rising strategic importance. At the same time, global demand is surging. Saudi Arabia has been buying large amounts through silver ETFs. India's silver demand jumped 431% year over year in May, and June saw record ETF inflows despite higher prices. While retail demand hasn't yet fully caught up, institutional investors, central banks, and sovereign wealth funds are clearly positioning silver. Andy is a well-known precious metals expert, CEO of Miles Franklin Precious Metals, points out that a large amount of gold and silver has recently flowed into COMEX, with September deliveries hitting 267,000 ounces of gold and 42 million ounces of silver, an unusually high figure. At the same time, short positions in SLV are surging, signaling major moves behind the scenes. The recent BRICS and Shanghai Cooperation Organization meetings also highlighted a geopolitical shift. Trump's threat of 50% tariffs on India seems to have backfired, since U.S. trade only makes up less than 3% of India's GDP. This is why leaders Xi, Modi, and Putin demonstrated unity at the SCO summit. Andy highlights that the SCO is not a minor group, it represents over 40% of the global population, 35% of global GDP, and nearly a quarter of the world's land area. Modi emphasized India's strategic autonomy, making it clear they will not sacrifice long-term interests. Meanwhile, China is investing in mandatory AI education from primary school upward, preparing its youth for technological dominance, while many Western youths focus on social media aspirations. This difference in priorities, combined with U.S. policy missteps, risks leaving America behind. Adding to that, U.S. stock valuations are now at record extremes, higher than even during the dot-com bubble and Great Depression, with investors heavily leveraged and exposed. Insiders appear to be exiting while the public piles in. If you enjoy the content, don't forget to give us a thumbs up and subscribe to our channel for the latest updates.
A lot of gold and silver coming into the market, into COMEX. So far for September, 267,000 ounces delivered. 42 million ounces of silver delivered, which is huge. We talked about the shorts are up big time in SLV, which is huge. We talked about the BRICS meeting, the Shanghai Cooperation meeting. I think what I take away from that is that Trump overplayed his card with India, threatening 50% tariffs. When you look at the actual numbers, even though we are their largest trading partner, arguably, it only accounts for under 3% of their GDP, their trade with us. You look at a country like Mexico or Canada, where it's the majority, that's different. We'll have greater weight. The purchase of Russian oil for India is far, far more important to them. And this is why you see Xi and Modi and Putin shake hands and smile and hug at the Shanghai Cooperation meeting. The SCO is no small organization. I've talked a lot about it on your show. It's over 40% of global population, 35% of global GDP. 24% of the land area. And so when you talk about takeaways, I think the fact that Modi stresses strategic autonomy, will not trade long-term interests for short-term appeasement. And, they're making stronger ties with Russia, with energy and defense and security. One of the things that I found interesting was that China is now embarking upon mandatory AI education from primary school, building all the way up through high school to build a AI talent pipeline. And so I found that to be very interesting. I also found it interesting that of all of the Gen Zs polled, that the number one job that came out on top wanting to be was a social influencer. And yet you have all of these kids in China that are becoming engineers and astronauts and becoming proficient in AI from elementary school on. These are the things we're getting left behind, whether it be in the way that our kids are being raised with education, or what's happening in our U.S. foreign policy missteps under the Trump administration. As much as I would vote for him again, I think he really overplayed his hand with a country like India. And, I think that these are the kind of mistakes that are going to have ramifications with the continuing emergence and strengthening of not only the Shanghai Cooperation Organization, but the BRICS. We have not heard the end of that yet, but I found it interesting that more or less Modi came out and said, we're not going to back down from our relationship with Russia and or our oil purchases from them. It's more important than just about anything right now. So how this all plays out, I guess we'll see. But putting 50% tariffs on India was, I think, a big misstep. And that's what I took out of the Shanghai Cooperation Organization meeting. Other than that, like I said, likely to see payrolls be revised. I've read from anywhere from 500 to 800,000, which they will use to justify rate cuts. But when you have U.S. stock valuations now at the most expensive in history, surpassing the dot-com and pre-Great Depression levels, you got some serious risks ahead if indeed they do this, as the public is all in on equities, all in on margin, all in highest ever, and all in on options exposure highest ever. That's a dangerous market as the insiders are moving this way, the other way. So I don't know. It's not too much happened that is off the charts this week. I'm sure there will be by next week, but just more continuation of the same.
Andy explains that 8 major Western banks hold the largest concentrated silver positions ever seen on COMEX. This isn't just about controlling price. Though prices have been deliberately suppressed, it's mainly about maintaining access to silver stockpiles. Silver is unique because even tiny amounts are critical in high-value products, from cruise missiles to iPhones, so availability matters more than price. Rising prices would attract investor demand, but there isn't enough supply to meet it, which is why the market has been manipulated. Now, however, silver is recognized as a truly strategic metal. Although silver has risen to around $42 in mid-2025, a level many would have celebrated a year ago, analysts say this is just the beginning. With global players like Russia, India, Saudi Arabia, and China aggressively buying, and U.S. demand on COMEX also surging, the market is tightening. Once the retail side wakes up to this reality, shortages could spill over worldwide, and that's when silver prices may truly explode. For now, it's still an opportunity for early investors before the real fireworks begin. Now let's dive into the interview.
Banks, and I'll talk about Ed Steer's chart again that you showed several months ago. When you see 8 Western banks that maintain the largest concentrated position of any commodity ever traded on COMEX, it's not to hold down the price. Well, it is, but it's not price that's bothering them because silver is inelastic. You don't need a lot to make a very expensive item. Even if it's 500 ounces in a Tomahawk cruise missile that costs millions and millions of dollars, or a fifth of or sixth or eighth of an ounce in an iPhone, the cost of the finished product is so much higher than the little incremental price of silver. It doesn't matter. More along the lines of they've tried to step on it because rising price would attract demand, and there's not enough availability of it. The price has been skewed by the trading on COMEX and the LBMA. It's real value skewed, and so I think the rising price would attract investors, speculators. They don't want that. It's more along the lines of being able to access stockpiles of silver rather than the cost of the silver. I know that sounds kind of strange, but if you're making it for all of these critical components, it's less about the price and more about the availability because it's used in such small amounts in whatever the finished product is. But you're right. It has been suppressed. It has been held down. It has been manipulated. And I think now there's a race to accumulate it because indeed it is strategic. It is critical. It is needed not just in electronics and electrical components, just about anything that conducts electricity. It is needed in military components. It is needed in medical devices. It is needed in so many places, solar panels, etc. And that plurality of demand, from monetary demand to military demand to industrial demand, makes it strategic, every bit as strategic as any of these other strategic metals. And I think that's the change, is that Trump understands that, his administration understands it. So, this is something I think that will continue, and there will be at some point, I see a battle between the industrials and the, or shall I say, the manufacturers, the producers who need it, and the investors. So you're going to get companies like Tesla and Panasonic and Sony and whatnot in a battle for what's available. As the hedge funds and the investors start to take the other side, they're going to battle, and it's about availability of a depleting asset. It's not as much about the price, but just about the availability. And you start to wake everyone up just like that, it disappears. And what is a shortage on COMEX spills into a shortage globally across the board into retail as well. Not there yet. There's still great values, but I see that happening as where this ultimately goes to. But if I would have told people, a year ago that we'll be staring at $42, in early, mid-2025, I think most people would have been happy about that. Quite frankly, I think it's just beginning. We're a long ways away from seeing where this ultimately stops, but this is where it should have been a long time ago, and I think it's still got a lot of room to run based upon everything that I'm seeing, whether it be anecdotally or economically, or just by the movements of the biggest players in the world with Russia and India and Saudi Arabia and China. They're all gobbling up silver as fast as they can. Evidently, so are the folks in the United States now, too, at least on the COMEX. When that translates to the retail side, which I believe it will, something will wake up the public, that's when we'll see real fireworks. And, of course, we're not there yet, but that's a benefit to all of you who are trying to add to your portfolio before the prices get out of hand.
Silver's transformation from a quietly suppressed asset to a recognized strategic resource marks a turning point in global finance. With record institutional accumulation, geopolitical realignments, and growing industrial needs, the foundation is being set for a historic silver bull market. The window for early positioning is narrowing, as both governments and major investors move ahead of the public. How soon could retail investors begin to feel the global silver shortage already affecting institutions? Could U.S. policy missteps accelerate silver's role in a new multipolar financial system? Share your thoughts in the comments below. We'd love to hear from you. If you found this helpful video, don't forget to give it a thumbs up and subscribe for more content. Thanks for being a part of our journey.